Hit it.
It's Friday, November 29th, 2024, episode 252. I'm Patrick Serezna.
And I'm Kevin Muir. This week, with U.S. Thanksgiving kicking in, we had some extra time, so we grabbed two non-North Americans for an interview. We start with Imran Lakha from Options Insight, who joins us to talk about SPX option trading, the Mr. Self-Reinforcing cycle, and how he is navigating this interesting period. Then we have Darren Dempsey from Harkster, a former FX trader who is using AI to solve a problem that many portfolio managers face today. Then Patrick takes the crayons out of his mouth to tell us what he sees for markets in talking charts.
And folks, I might drink some beers along the way, but it's a little too early for these lightweights when we're recording this in the morning.
Well, we're not all alcoholics like you, Pat. So
he's a recreational alcoholic.
Functioning alcoholic, yeah.
I barely. Oh, wow. All right, Kev, give us some disclaimers.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Wait. Side effects of too much huddle may include.
Pat, why have you disappeared?
Let's just leave all this in here. Turkey tantrums, stuffed and stretch syndrome, and holiday hangover hurdles.
Oh my God.
Let's go to the guests.
All right.
Well, it's our great pleasure to welcome to the show Imran Lakha, the founder of Options Insight. He's a former institutional option trader from the likes of Credit Suisse, Merrill Lynch, and Citibank. Imran, thanks for joining me.
Pleasure to be here, Kev. Nice to meet you.
It's been a long time that we've been trying to get this going. We finally got a chance to do it on this holiday slower week. Before we kind of get into your views on the option market, and you are an option specialist, so you do have a lot of great views about a million things like dispersion trades and zero TTs and the likes. Before we get to that, why don't you tell people a little bit about yourself, a little bit about your background and your career through Wall Street?
Sure. So started back in 2001, if you believe. So a bit of an old hand at this. Started at Credit Suisse, sort of earned my stripes there. Ended up going to Merrill Lynch. Traded through the financial crisis in 2008 pretty successfully.
Okay, because you're going to go on to the next thing. And when you mentioned this earlier before we were recording, and I was like, oh, geez, you were at Merrill Lynch, a firm that got into a lot of trouble in 2008 in terms of their actual own proprietary book. But you guys did well. I was just could you share any stories at that time, like in what it was like trading options? Because up until then, we had never seen VIX and implieds, jump to those sorts of levels. And I'm assuming since you said you guys did well, you must have been long. What did you see? How did you guys position? Just any war stories I'd love to hear.
You love a war story.
Yes, I do.
War stories are great. I mean, it's funny because it feels like such a long time ago as well. But basically, because when you're in a bank like that, it really serves you well to speak to people in other departments of the bank, in fixed income, in credit, stuff like that, right? And I started as a graduate in the industry, so I had lots of friends who worked in lots of different departments. So when I was at Merrill, I had a friend who was very senior within the credit department. And throughout the whole of the back end of 2007, he was just like, oh my God, it's Armageddon. Like the credit market is blowing up like you've never seen. And I'm like, equities are smoking crack in the sky, mate. Like they don't care, right? And it was like there was this massive dichotomy between credit and equity, and it basically warned us that equities might be ignoring it right now, but there's a lot of unhealthy stuff going down in the credit market, right? So that was kind of a warning for us to make sure we started positioning ourselves to at least not be short downside optionality, right? So like make sure if markets were to suddenly wake up and go down, we would not be short, and if anything, we'd be long vol if that happened. So that was generally how we started positioning. There was a bit of a weird event in Europe that happened early that year. Like there was a bit of a freak scandal that occurred in Europe in January 2008, where someone, I think his name was something like Jerome Kerviel or something at SocGen or something like that, and he was doing some dodgy shit in Delta One, and he created a bit of a mad fire sell on Euro stocks that crashed the market 10% in one day. So we were generally positioned bearishly anyway. We didn't see that happening, but that happened and we made a shitload of money in January.
Okay.
So that was nice. That was nice because that money set us up to then be able to kind of be patient and be generally long vol and losing money for most of 2008. but because we got that nice little Brucey bonus at the start of the year,
Right.
we were able to withstand that and hold the positions, because all we ever heard from anyone in credit and anyone in senior management was that, yeah, the world's blowing up basically, but equities don't seem to care yet. So we were generally very long downside. When it all started kicking off in September, then clearly the positioning worked. But the funny thing was, I had a boss who I will never forget. He was like, he's one of the best traders I've ever seen. And the reason I say that is because it's really easy to buy vol when it's at 20 and you think
Right.
the world's going to blow up. But it's much harder to go limit long vol at 40 when it looks like the world's already blown up, but you
Right.
think it's going to blow up more, basically,
Yeah.
right? So whilst we did get a bit long, we didn't go limit long until vol had already blown up and the markets were like in a bit of a state of disarray in September, and there was short selling bans being put in place and markets were squeezing 10% in a day and shorts were getting killed. And he was just like, there's no way vol's not a buy at 40, basically, right? He's like, I don't care what you say, don't care what these guys are doing. Look at how these things are moving and the world we're in. I'm going limit long at 40. So he went limit long at 40 vol.
Wow.
And then in October, vol went from 40 to 80.
And just to set the scene, 40 vol at the time was probably the highest that index had ever been, right?
I don't know about ever, but certainly it would never have stayed there for very long, right? That was a high inflated level, right? So you got to respect a man who can zoom out and just be like, yeah, this is a different world, and 40 is a buy. It's a own, basically. And so he killed it. I mean, I was a bit more conservative, so I was like positioning in skew and doing relative value trades where I'd arbitrage the surface so that I could kind of win in any scenario. Like if the market rallied, I'd get taken short vol. If it sold off, I'd get taken long vol. I wasn't so high conviction that, yeah, it's going from 40 to 80, but he was. And like as a desk, we just absolutely cleaned up. It was ridiculous.
That's a great story. Yeah. Okay. So from there you go to Citibank, and then eventually you go and you decide that's it. You decided you've had enough with the sell side and you go start your own newsletter.
Yeah. So, I mean, it was a weird one. Like I wasn't really sure what I wanted to do. I tried my hand at the buy side. It didn't really work out. It wasn't as glamorous as I kind of thought it was going to be honest. And I was very much this type of trader who wanted to kind of be around others if I was trading. So a bit that kind of camaraderie you get on a trading floor. You didn't really get that in the hedge fund side, certainly not where I went. But then I always loved teaching. So whenever I was at the banks and all the grads and the interns would come through, I got a kick out of teaching them, basically, right? Okay. So I thought, why don't I try my hand at teaching and create a business that's uses my 20 years of experience and then lifts the lid on options and shows people that it's not rocket science and you don't have to be a PhD, and just kind of explain it in a more intuitive, understandable way so people can really start to get it and get the practicalities of it and how to make money out of it, really. That's the goal, is to show people how to make money in trading, not to like just kind of overly intellectualize it and talk about models and all these things that how's it going to actually make you any money?
At the end of the day, the models are just a tool for you to trade and make money on. And if you can't do that, then there's no models that's going to help you.
Exactly.
All right. So let's talk about the current environment, because it is a wild one. And one of the things that you did talk about with your members is the setup going into the election. And you guys nailed the trade in terms of trading VIX or trading volatility around it. And you capitalized on something I've heard other people talk about, is the fact that often going into an election or any sort of event, you get this kind of sell off in vol, and it's almost like no matter what happens, that is like almost regardless of the outcome, you're going to get a sell off in volatility. Why don't you walk us through how you had positioned and what you were thinking and how it all worked?
Sure. So that what you're describing there, I generally call it the vol reset, right? So what you tend to get whenever there's a well-flagged, well-telegraphed event that the whole market knows is potentially volatility-inducing, then implied vol reflects that. And the closer you get to that event, the implied vol rises, because the market knows that this is not a normal day. There's a special event that's going to pass. And once that event's passed, the vol surface is going to go back to a more normal state, right? So that's the dreaded vol reset, basically. Like it happens when there's earnings announcements on single stocks. It happens on FOMC meetings if it's a big one, not massively, but a little bit. Big inflation data prints, but certainly elections are very much an event where there is a vol premium, right? So we knew that was coming. We knew the vol was going to be very firm into the election. It started to reset a little bit earlier just because Trump was becoming higher and higher probability by certainly the people who were actually in the trading world, who were actually putting money at risk. That cohort was generally more pro-Trump and thinking that Trump was going to win. So you started to see that stuff already being slightly priced in. But, you know, it happens every time. I mean, it happened on the last election. It happened on the one before. So once you've done this a few times and you've seen a few of these cycles, you know, yep, vol's going to go bid into it. And then generally it's going to get slammed. The only risk of vol not getting slammed was if there was a really close split and it was contested and there was civil unrest breaking out and it was just that kind of nonsense, then maybe vol would have persisted bid for an extra few weeks or something, right? But the seasonality for vol going into the end of the year is generally for it to go down anyway. And when it's been held up for an election, then you know that stuff is coming down, right? So that was the layup trade, right? I was telling everyone the best risk reward out of anything, doesn't matter who you think is going to win the election, best risk reward hands down was to short vol. Now, shorting vol in itself can be dangerous. So you have to know how to short vol. You can't just go and smash out a load of VIX and get your head chopped off, right? That's just stupid. So that's why you need people who've been in the game for long enough, who have got smart ways to sell vol that are not going to hurt you, basically, right? And that's what me and my community were doing.
Were you focusing on VIX options, or were these strategies on SPX that you were implicitly?
We had a combination. Yeah, we had a combination of VIX options and VXX options.
Okay. All right. One of the things that you also, recounted earlier was the fact that you are an active trader of VIX. And one of the things that you did do in the summer when we had that spike with the kind of yen carry trade unwind and the spike in the VIX is you actually sold that rally. And I was wondering, what gave you the confidence to sell that rally? Because at one point it looked like it almost might kind of become self-fulfilling, and you get the VIX rally, you get the Vanna selling on the Delta, and it kind of feeds on itself, and it's summertime, and yet it was quick, it was sharp, and then next thing you knew it was gone. And it sounds like you nailed that trade. Why were you confident that VIX rally was something that should be sold, as opposed to like your old boss buying the VIX even though it was higher?
Yeah, well, the reality was the trades that we were setting up weren't going to hurt us that badly if the VIX doubled from there, basically, right? So the point is, a good trader doesn't put positions on that are symmetrical, right? You don't put on positions that if you're right, you make X, and if you're wrong, you lose X, right? What you want to do is you want to put on positions when you can, and you'll get a handful of these per year, basically. You want to put on positions where if you're wrong, you're going to lose a tiny amount. And if you're right, you're going to make a lot, basically, right? And so once you kind of know how to trade these things and these products, and you understand the gravity that is typical in the VIX is like when you throw up a stone, right? At some point, it's going to reverse and come back down. You just don't know when. You don't know how fast, right? But it's because that gravity exists in the VIX. If you've got the dry powder when a VIX spike happens, you've got capital to deploy, then there are some really nice sort of trades that you can do that aren't going to hurt you too bad, even if it keeps going. Again, it's using VIX optionality. It's not using VIX futures, but using VIX optionality, you can do nice trades that set you up for a normalization where you can make good money, good return on capital. But if it keeps going, you're going to be able to stop out or not lose too much, quite easily. Right?
Are they as simple as buying put spreads, or they're much more complicated?
No, they're a bit more complicated than that. It involves a bit of calendar stuff and things like that. But it's just put spreads don't really often price that well in VIX because of the way the skew moves, the way the vol moves on the VIX spike.
Right.
They actually look quite expensive most of the time, the put spreads. So they don't give you any leverage. The thing that you want to try and create in options is you want to create leverage for yourself. So you want to create a situation where like the amount you're spending or the amount you can lose is very small compared to the amount that you can make, basically. So you have to synthetically create that leverage via doing certain calendar type structures that you obviously have to understand it a bit, right? But like that's what we do,
Fair enough. Now, one of the things that you mentioned is there's a VIX seasonality, meaning that often going into the year end, you get this kind of smush in terms of VIX and a rally in stocks in general. Our buddy Jem Carson has kind of highlighted the fact that there's these structured products that are kind of increasing in popularity and contributing to that seasonality. I was just wondering if you could comment about structured products in general, also their increase in usage, and how that works in terms of what's happening going into the year end.
Sure. So I think the biggest sort of themes within structured products tend to be, obviously, it's vol selling, right? Most of the time, vol is being sold across the curve in all shapes and forms. Okay, and typically there's downside buying.
Okay.
So vol selling and downside buying, because a lot of these products need to cap their downside and stuff, so that they'll buy those downside strikes to protect themselves and things like that. So you generally get a lot of vol selling throughout the year. It's not just the seasonal towards the end of the year, right? Vol selling is kind of happening throughout the year. Yeah. But typically, because you go into the Christmas period, and markets tend to go a bit quiet, that's why you see vols generally drop into the end of the year as people are winding books down and stuff like that. And then you also get that dip in Easter usually as well in vol, right? So they tend to be the periods where you get dips in vol. But the kind of thing that Jem talks about, the Vanna and Charm flows that kind of accelerate towards the end of the year. The reason they exist is because a lot of the hedging programs that are done in the option space via structured products, or even via, just general institutional hedging programs, they tend to be buying December and January options, like on the downside, right? So the largest chunks of notional of the hedges are often done, a year or two ahead of time. They're done, and they're done in those December and January buckets. So the accumulation of buying, of protection, is all adding up onto those December, Jan expiries in the US, basically, right? So then as you get towards those December, Jan expiries, because those notionals are so large, and as that protection is kind of burning away like through time, it doesn't require as much delta hedging against it. It doesn't require as much short futures against it, right? So that's what tends to happen. You tend to get that extra tailwind to the market as a lot of all that protection, as the charm kicks in closer to expiry, basically, right? So as you get closer to expiry, all those options are eroding and they're decaying away. And as they decay away, there's a short cover from the futures that have been bought against them. And that's what he talks about in his structural flows stuff that he says. Yeah.
So for people who don't know, charm is the change in delta based upon a change in time. So as time goes through, and what Imran is explaining there is the fact that if you go and you're a dealer and you're short the put, someone's bought downside protection, then you're short futures against that short put. And then as it gets closer to the end and there's no chance of the put finishing in the money, you actually have to cover the put, the futures. Is that correct?
Yeah, exactly. And also, like, if you think about it, the more skew there is, like if the skew is really steep, like the vol that people are paying for the downside is really high relative to the vol of the upside. If that skew is steep, then that means the delta that you're going to be selling to protect that trade is going to be more. So because we've seen an elevated level of skew for the last few months, certainly before the election, that meant that there was a lot of delta against all that protection that had been bought, right? And so there was even more conviction that when the vol dropped and when the time passed, there'd be a load of delta to cover. If the skew was really, really flat, then that would be telling you that the positioning isn't as big. It's not as large. The delta's not as big there, basically, right? Yeah. So not only is there not been as much flow to drive the skew higher, even the flow that there has been, the deltas are relatively less than they would be on a steeper skew, right? So that's the idea there.
So let's just explain skew a little bit more, because you'll hear Jem and you guys, options experts talk about skew, and it kind of, you'll quickly kind of go over and say, oh, the street's long skew, the street's short skew, or whatever. So generally, if I got this right, generally the trade is they are selling downside puts and they are long upside calls, the dealers, meaning the clients.
dealers.
The clients are asking them to sell them protection and to buy upside calls.
Correct.
And so
in
they are
index land, particularly in index land.
correct. Okay. So and the reality is that for that strategy to end up being profitable, the dealer needs to charge more for the put than they're buying the call vol for, right? And so when you're talking about the dealers are short, that would imply they're short skew. Is that correct?
Yes.
Okay. So a lot of times you'll talk about them having to go and cover skew. That means that they're too short on the downside and they'll be trying to buy up those puts and sell the vol that they own at the front end. Is that correct?
You mean the upside vol?
Yes.
They won't really need to sell the upside vol. If it depends if you're talking about if we've already dropped and we've moved down,
or just in general, like when you guys start talking about like they got to go and they're short skew and therefore they have to bid it. So you're saying they don't even bother with the
No, I'm just saying like generally they're happy to sell the skew, but it's kind of a risk. There's kind of a risk tolerance there, right? It's like how much skew you're allowed to sell. It's probably going to work. It's probably not going to realize. You're going to be earning time decay. You're going to have the Greek profile that you have when you sell skew is a nice Greek profile, right? You are flat to long gamma, and your time decay is minimal, or you might even be earning time decay, right? So it's a really nice headline profile if the market doesn't puke, right?
Right.
So you don't really need to rush out and like get out of it. It's just that there's a limit to how much skew you're going to be able to sell. So if the buyers just keep coming, it's going to have market impact on the surface because market makers at some point have got risk limits and they're just going to be like, okay, it just keeps coming. So I'm just going to have to raise my price, right? But they like it because they're probably going to make money off the realized and they're probably going to be able to monetize it through time. But there's a limit to how much skew they're going to sell. They're not just going to be there and be like, yeah, have as much as you want at that level. So when you see skew move, like that's why you need to track these parameters, which is what we do at Options Insight. You track where skew trades in its ranges to get a sense of how dramatic is the positioning, right? If skew's just trading mid-range, it's not really telling you much, right? But if skew's trading in the 90th percentile, you know that there's been a load of buying of protection to drive it there. So that gives you a better indication of how the street is likely to be positioned. And then there are implications to that, basically. So the reason a lot of the time you're looking at the parameters isn't just to decide if they're cheap or expensive and if you want to trade them. It's to give you an indication of which direction the positioning has been moving, basically.
Got it. Yeah. And when you talk about skew, what is the most likely, how far out do you usually focus on?
Well, I mean, the standard skew measure is the 25 delta risk reversal, right? That's just the standard one.
On what tenor though? Like on what? I
mean, I always look at the 1 month.
You do?
I think the 1 month has a nice balance between, it's volatile enough that there's some signaling value in where it is. Yeah. Right. But it's not so short dated that there's no vega on it, right? If options get too short dated, then there's no real vega on them. They're just pure time decay. They're pure premium and gamma, basically, right? They're not. Okay. The actual implied vol impact isn't that big, basically, right? But in that 1 month bucket, it does have impact.
So you watch the 1 month skew for a feeling of where the dealers are positioning so that you can therefore adjust your trading based upon that.
Yeah, I watch the skew to track how short or long the positioning is. So for example, we get a lot of these gamma models out there. I mean, I'm very good friends with Spot Gamma, people like
Brent.
that.
Yeah, he's a terrific guy. Yeah.
Yeah. So like Brent, let's say Brent's models will say that dealers are long X amount of gamma up here and they get longer as the market rallies. Okay. And there's a big strike concentration and we know that there's a big strike concentration right now at 60-50 on the S&P because there's the big JP Morgan collar strike up there.
Right.
Okay?
Yeah. Understood.
So now, but we all know that. But let's say we didn't know that. Okay. So let's say we didn't know for sure that strike was a long strike for the dealers. Okay. We saw the open interest 20 billion up there. We were making an assumption that the dealers were long that strike and not short it. So what you want to see then is when the market's trading up above 6,000, you want to see that realized vol is very contained, right? I.e. the market's struggling to move more than 50 bips a day. and you want to see the implied vol in December options, end of December options, is well offered, basically.
Right.
And that is on a fixed strike basis. In other terms, you look at the actual strikes and what the vol of that strike has done as you are approaching that area, right? And if you're seeing that the fixed strike vol is collapsing and the market's kind of realizing, all right, 50, 60 pips a day, and yet the implied vol is collapsing, that is confirmation that the street probably owns it, basically, right? Because the street's theta bill, the street's decay bill is going through the roof because the amount of gamma is increasing on that thing as you get closer to the strike, as you get closer to the expiry. And it's like, if I'm a market maker and my theta bill just went from 100 grand to 500 grand, I'm not just going to sit there. I'm going to sell some bloody options. And if I sell some options, the vol's going to go lower, basically, right? So the moves in vol are telling me what the positions are and what people are having to do, basically. And that is helping reinforce my idea that, okay, if the street's massively long gamma here, the chances of the market being able to have a big move are going down. So then I can position myself for the market to be range bound, et cetera, et cetera.
Got it. Okay, that's great stuff. Let's talk a little bit about zero DTEs and their increasing popularity and how they've affected the SPX market and even the underlying.
Yeah, I mean, it's amazing. I mean, they account for like half the volume now, right? So they are, and I trade them as well. I couldn't help myself. Right? I mean, I had to get involved. But yeah, I mean, I think the great thing about zero DTEs is they allow you, I think from certainly a lot, I know a lot of retail people who do this, and I'm sure loads of insto. Obviously, the size of the blocks that go up, we definitely know instos do it. But the iron condor selling is just like the favorite trade, right? Because it's like you can limit your risk, you can make your money in a day, and you can lean on the fact that the positioning of dealers is long, basically, right? So, like, why would you not do that? The return on capital at risk is too freaking nice to ignore, right? Like, I mean, I can do an iron condor that uses, $1,000 of margin, okay?
Yeah.
And I can make like 10 to 20% return on margin in a matter of hours, right? Why would I not just do that and compound the crap out of that, basically, right? It's just, that's why it's just too good, right? That's why so many people want to do it. So there is this constant supply of gamma coming from people who are doing this trade, right? Now, on the flip side of that, when there's a big macro data point or whatever, because of that constant supply of gamma and the relative cheapness of these one-day options, you get like big asset managers who are like, I could do with a hedge today just in case this number does something silly.
Yeah.
And they'll just come in and buy a load of protection for like a 2% drop, and it's super cheap and efficient for them to do that. So occasionally you'll get them come in and do it. I mean, I've got friends in the asset management community who do use those from time to time. But in general, the trade is to be selling gamma and harvesting that premium systematically through these zero DTEs.
And do you worry about this being a potentially kind of destabilizing factor to the market?
I mean, it maybe can exacerbate a move intraday if let's say a move could go from 2% to 4% because a load of people just got lifted out of zero DTEs and it just kind of started to cascade on itself. But the truth is, by the end of the day, all the options have expired and it's all cleaned out, right? So it's not as systemic as like longer term Vega and longer term skew positioning that is like, there's no liquidity to get out, basically, right? And people are stuck with it, and right. So I feel like that's the good thing about it. So sure, maybe it can create air pockets in the market where like I say, like a 1 or 2% move turns into a 4% move,
right?
But we don't see that very often, right? And the truth is, I feel like a lot of the time, because of the availability of zero DTEs as well, in that 4%, in that overshoot, then you'll probably get zero DTE call buyers come back in and buy it back by the end of the day as well. So it's just this super liquid instrument that allows people to gain leverage intraday and express their views. And it's just making gambling on markets just so easy. And so you know what I mean? It's just allowing people to just like have ridiculous high octane leverage to their intraday views. But I don't think it's something systemic that really blows us up.
One of my buddies said something to the effect. He says, I think it's going to increase the number of 1 and 2 standard deviation, or sorry, decrease like the short-term volatility of the stock market, meaning that we're going to get more 1 and 2 standard deviation moves. And then it's going to increase the chances of a 3 and 4 standard deviation move, to your point, meaning that when it does bust, it's going to bust big.
Yeah, it's possible. It could do that. But like I said, but it'll be a one-day thing. It won't like then keep the market in a mess for the next like 2 months, like it used to do back in the day.
Right.
When there was a blow up. Yeah.
All right. One of the next things I wanted to chat about in terms of a popular trade that some people have focused on is the dispersion trade. Could you explain to people what that is, what dealers are doing, and how that might be influencing the markets?
Sure. So it's not, well, it could be a dealer thing, but generally it's the point of the trade is to say that, you think the index is going to be relatively range bound, and you think the single stocks themselves are going to be volatile. And what you're saying is certain stocks will go up, certain stocks will go down. The index doesn't have to go anywhere. So I want to own the volatility on the single stocks. I want to be short the volatility of the index. Right. So the only time that will be a bad thing is when everything moves in the same direction. So if everything moves in the same direction, the index will have a big move and the stocks will all have a big move. But the index vol is trading at a massive discount, that I'm selling that vol at a massive discount because I'm assuming some benefit of diversification that is going to mean that the index doesn't move that much, right? Because the correlation is not going to be 100%. So that was the idea. So the idea, correlation used to, back in the day, like 10, 15 years ago, the correlation used to trade at like 50% or something, okay? Generally, right? And then often it would be realizing less than that, right? It would realize like 20 or 30%. And you could basically pick up some really good money by having that dispersion trade, being long the stocks, being short the index, and you're just going to collect money through time as stocks do their thing, okay?
Yeah.
Now, that trade generally loves interest rate volatility, right? Because what happens when interest rates become really volatile, it impacts some sectors in a good way and some sectors in a bad way. But the index doesn't have to do that much, right?
Oh, I've never thought about that the dispersion trade is actually, it's like a positive move trade.
Yeah, it's a positive. Exactly. It's a positive rates vol trade. Yeah, sure. And the reason I know that is because I was sitting next to a load of dispersion traders in 2016 when Trump first got in.
Yeah.
And the rates curve moved I called Trump getting in 2016, right? I was one of the only people on the whole damn trading floor who predicted that Trump would get in, right?
Okay.
And I positioned bearishly because all the analysts were saying the stock market's down 10% on a Trump win, basically.
Right.
Okay? And it wasn't being priced. So I set up my book nice and bearish. I go away. I go to sleep. I come in the morning. I'm the hero. I've predicted it. Market's down 5%, limit down in the futures. Everyone's like, how did you know? How did you know? And then I'm like, okay, well, we're not down 10% yet. So when the stock market opens up, we're going to be down 10 and then I'll take my profit, right? By the time the market comes back in, we're unchanged. With Trump suddenly appearing presidential in his speech, and people are like, oh, you know what? It's not that. But really what happened was the rates market moved a lot because the rates market basically said, okay, he's going to go and spend on infrastructure and do all this stuff for the economy. And that was the rates. So the rates market moved some monster amount, like 50 bips or whatever.
Yeah.
And when it did that, the dispersion that it created in the dispersion books for the guys next to me was insane. So all these guys who had no clue that Trump was going to get in, no clue, made $5 million on their dispersion books. While I called Trump getting in and I didn't even make any money. It's a nightmare, I tell you. It's like...
It's harder to make money than to be right. That's wild.
That's the thing. People don't realize that in trading. You'd much rather be lucky or make money than be right.
Yeah. Exactly. Okay. So the move, obviously, the move index being the kind of VIX of fixed income is very important for this. But what happens if we have a situation where correlations all of a sudden go up to 1 or closer or head towards 1? Doesn't that mean that this prevalence of the increased popularity of the dispersion trade will make the unwind in terms of a VIX bid all the larger? Because these guys are going to be short index vol and they're going to be long individual stock vol. And then all of a sudden they're going to be like, oh, geez, I got to take this off. and I got to go and I have to cover, and their covering is by buying back VIX vol. Am I not correct?
Well, maybe not VIX, but yeah, it's S&P, maybe S&P vanilla, but it will impact the VIX. But the VIX is only the front end, right? It's only the 1 month stuff. Right?
Yeah. Okay. Sorry. So
if people have got like dispersion books with durations of like 1 to 5 years on, then the VIX isn't really the
fair enough. Understood. But they will be bidding for SPX vol.
Yeah, but I think the reality is just that the reason that trade exists is because there's just an overwhelming supply of index vol, right? And that is kind of how that index vol is being recycled, right? As in, for example, like whenever single stock books, like exotics books used to all have quite a lot of supply of Vega, right? So you used to get a lot of structured products in singles would make single stock exotic books long single stock vol.
Right.
And they would then sell index vol against it because that was where the liquidity was. So those dealers' books already had the dispersion trade on. Right?
Fair enough.
So then what's happened is like hedge funds have come along and said, oh, we'll take that off you and we'll buy, but we won't do it in the same form. We're not going to buy your exotics off you. We're just going to buy single stock vol off you in vanilla form. And we're going to, sell index to you and basically take you out of that spread. So, you've got a load of basis risk on between the products, but overall your Vega is kind of flat single stock versus index. And we have now got that on, right? Now that trade, because it's been so successful, it has got a bit big, right? And it's becoming the tail wagging the dog. So for example, a day when one of the big Mag 7 names has like a big move on news, right? It will move. And then just because the index is being pinned and held still, it forces other names to go in the opposite direction, right? Just through the kind of hedging dynamics of that dispersion trade being so large. And it's crazy that it's becoming the reason why some stocks are moving is because the dispersion trade won't allow, right, the index to move because there's just too much index vol around that is pinning it. It's pretty crazy. Like it is a situation
it is wild. And I've seen it. Like if all of a sudden if NVIDIA goes for sale hard, you'll see Apple go bid or the rest of the Mag 7 go bid.
For no apparent reason. Yeah. Agreed.
But so you're not worried though about that increased risk causing some sort of event in the markets?
I mean, I think it would require a macro shock.
Okay.
That is persistent. It would require a macro shock that is persistent enough that those hedge funds would get tapped on the shoulder and say, because what's happening is even if the implied vol pops and the correlate, let's say I've got a book and my correlation is marked at 20. Okay. And then something happens and then my correlation is now marked at 30 and I've taken a mark to market hit of 10 correlation points.
Right.
As long as the book is carrying itself well, as long as, I'm making some money back every day through theta and gamma because the market is still dispersing.
Fair enough. Like realized dispersion is less than you're marked at.
Yeah. As long as I can, exactly. As long as I can continue to capture that, then I can justify to my boss that this is just mark to market. This is part of the game. This is part of this trade that we knew going in. But there's nothing structurally changed that is going to stop this thing realizing in our favor, right?
Okay, fair enough, understood.
But if there's something structural that makes the index go crazy and stay crazy and realize correlation stays high, and for the foreseeable future, we have no idea when it's going to come back. Yeah. Then you might get a situation where people get the tap on the shoulder and be like, okay, your risk is too big. You've dropped 20 correlation points here. Your position's too big. I'm sorry, you have to cut it down, right? Because and there is a risk of that. So, but it's really hard to know.
Fair enough. It would need to be an actual macro event that was causing that.
I think so.
Yeah, fair enough. That's understood. That's great insight. All right. One of the things that you have spoken about in the past is Bitcoin. We're not going to talk Bitcoin, but we're going to talk about something that's even more exciting. Yeah. It's the perpetual money machine that is Michael Saylor's MSTR. Why don't you share with people your insights about that and how convertible bonds and how it all works in terms of this?
Yeah. Now, I wouldn't say I'm like the foremost expert of it, but I think I've got a pretty good handle on what's going on. Right? So Michael Saylor, obviously, however many years ago, realized that holding US treasuries in his holding dollars in his treasury was not a good thing in real terms, right? We had inflation up here, you had yields down here, real yields were negative. He's like, why am I going to sit on negative real yields with my treasury when I've got this thing called Bitcoin that is going up 30% a year annualized? I'm going to hold it in that. So he switches all his treasury in I think it was like how much did he have? It was like $500 million or something, right?
When he first started, it was.
Yeah, $500 million, switched it all into Bitcoin, right? But then he just became this Bitcoin maxi, right? And decided, all right, well, that was an easy trade with money that I already had. But I've got the opportunity to now raise money at near zero interest rates and just put it all into this thing that's annualizing 30% a year. And I can just arbitrage the financial system because that's what's going to keep happening forever, right? That was the idea. So then it was like, okay, so he starts tapping the capital markets. And this is the clever part that he's done, which is he's by levering himself up to Bitcoin, which is kind of generally a 60 vol asset, let's say, on average, okay? By levering yourself up to a 60 vol asset, you basically, and that now becomes your main business, right? The rest of your business is so minuscule now relative to your actual market cap. You are now creating your stock that is trading on maybe 1.5 times Bitcoin, right? So maybe your stock's a 90 vol, 100 vol stock, okay? Yep. And so because you've got this volatile stock, you can issue convertible bonds. And the reason why you do that is because the convertible bond is a bond plus a call option. It's a bond plus a call option on your stock. And so he's selling call options, like, I don't know what the maturity is. Let's call it 3 to 5 year. He's selling 3 to 5 year call options on his stock on an implied vol of like 60, whilst his stock's actually trading on 100 vol, right? Moving around on 100 vol. So that's a massive discount for anyone who's got the sophistication to trade that product and take the vol on and gamma hedge the vol, which all these convert arb funds do. That's a steal if you can own that long dated vol on MicroStrategy at 60 when the guy is levering himself up and creating this volatility in his stock. So for them, it's a win. So they don't care what the yield is. They don't care that the yield on the convert is zero. And they're just willing to buy it because they have an embedded option in there and the ability to trade the volatility. So the misconception was that people were buying these converts as real money longs with zero yield and an embedded option on Bitcoin. So these were Bitcoin bulls. Nonsense, right? Majority of the people buying his bonds are convert arbs who are selling stock against those bonds, which is why there's a big short interest in the stock. Right. Again, so people are fear mongering, saying the stock's going to squeeze because of short interest. That's a load of rubbish because the stock has got short interest against the converts, and the converts have got an embedded call option, right? Yeah. So, but what I find interesting is like he's just got an endless amount of capital that he can raise when he's selling his vol at this big discount, basically, right? So I don't know when the market decides they don't want any more of his vol, they don't want any more of his converts. But whilst he can issue this and raise more and more money, he can keep buying more Bitcoin, and that is making Bitcoin go up more, and that is making his stock go up more, and that's allowing him to issue even more. So it's just becoming this self-perpetuating thing, which when we're in a bull market is great, and he's kind of, it looks like he's a genius. Yep. But at some point, I mean, yes, I agree that Bitcoin's annualizing 30% plus a year if you zoom out long enough, but it's also had years where it's down 80% in that time, right? So when it next decides to drop 80%, what the hell does MicroStrategy stock do? That's the question, right? I mean, and so I think there's going to be amazing opportunities to be going, in optionality and owning that downside left tail in MicroStrategy at some point. Because when you see this crypto cycle coming to an end, and it is like a 4-year cycle or whatever, and you think round the corner we've got a bit of a drop coming, you don't want to be selling Bitcoin. You want to be finding ways to sell MicroStrategy. Right. You can have a high octane way to participate in that downside. Right.
Imran, I've actually spoken about the fact that I believe there's an XIV potential situation occurring as well because of the fact that we have these double ETFs that are $3 billion. And so we have a situation where you have double the exposure, and all of a sudden, let's imagine Bitcoin is down 15% in a day. And then let's imagine that we already know that Michael Saylor's told you that, MicroStrategy is 2 times delta of Bitcoin. So it's down 30. And then if we have a narrowing of the kind of NAV, premium because of a general change, it doesn't take much to kind of envision a situation. Yeah,
you can wipe out the 2 times ETF. The 2 times MicroStrategy ETF can get wiped out to zero basically in a day.
Yeah, just like XIV.
Yeah, that's right. That's a very good point. Another reason to own the skew.
Yeah.
I mean, it's a bit early. I think it's a bit early to own it right now, but just because I do think the chances are at least into the inauguration, we're going to probably remain quite bid in crypto land. But yeah, it is. If you're looking like a year or two down the horizon, you definitely want to look for ways to own that left tail. I agree.
The other thing is that as he does more and more converts, what I think some of those convert buyers must be getting worried about is, yes, you're along the implied the vol, you're getting the Vanna.
With the credit.
But yes, exactly. There's a credit component that, and I look, there's no CDS. There's no way to really hedge that. There's no other bonds. So you have to kind of hedge it with the stock, really, is the only other way to do it.
Yeah. But right now, the credit's not an issue because he's like just flush with money, right? Like, and Bitcoin's up here. But you're right. When Bitcoin halves, suddenly the credit becomes an issue, right? Which, and that in itself, if you can't hedge the credit with CDS, what are you going to hedge it with? Short stock. Yeah.
I think eventually there's a chance that this thing goes to a discount to NAV. Like right now, it's trading at 2 times premium of like 2 or 3 in terms of.
I think it's 3.
It's 3. I think there's going to be a situation where it eventually goes to a GBTC discount, and people are thinking about buying it and selling off Bitcoin, like being able to come out and buy it and sell the Bitcoin and arbitrage it that way. But that we're a long way from that. Imran, it's been a real pleasure having you on the show. Why don't you tell people a little bit about where they can find more of your wonderful insights if they're interested in getting a little more sophisticated with their option trading?
Sure, thanks. Yeah. So basically, over at Options Insight, we are running a community of options traders. So we call it our Alpha Pod. So the idea is that obviously I've been doing this for 20 odd years, and obviously I do it in a fairly sophisticated way, in a way that kind of hedge funds and professionals would do it. So I don't really look at it like the average retail trader who just throws premium at the wall and sees what sticks, right? So I try to find trades that are a bit more risk adjusted. And also I kind of bucket all the trades into their Greeks. So like delta trades, theta trades, vega trades, things like that. So my VIX trades have all been in my vega bucket. But the idea is to educate, right? The idea is to allow people to enter that community, give them the training that they need to get up to speed in terms of our courses, but then also hold their hand through the process of practicing their skills and, really bouncing ideas off the community and myself. So I like to think of it like a global trading desk, like a global options trading desk that anyone can join. I'm like the head of the desk. I give you my insight every day. I give you my color. I share what trades that I'm doing, but I don't expect people to then follow my trades, right? That's not what you should do. You're here to learn. You're here to think about stuff. You're here to understand how I'm doing this stuff and why I'm doing it. And then you can do your own trades to reflect your own views. So that's the point of the service. So that's what we've kind of built. We've been doing that for like 5-6 years now. It kind of iterates all the time, right? We're trying to find what people want. And I think that's what we're finding some success now, that people do want that, right? People do really want to understand the basics and then implement them, learn how to go from an idea to a trade and then manage that trade throughout the life of that trade and do it in a way that, isn't going to blow you up, basically, right? I think there's not enough emphasis on risk management out there with a lot of the shops that kind of do this retail options trading stuff. So that's very much our focus.
All right. So again, it's Options Insight. And do you want to, so you can go to the website if you want to learn more?
So options-insight.com.
Okay.
We have a monthly subscription to join the Alpha Pod and have access to everything we do and be part of our Discord community. And we are offering Huddle members a coupon code that gets you 50% off your first month. So Huddle50, if you use the coupon code Huddle50, then you'll get half price on the first month.
Well, that's very nice of you. And do you want to plug a Twitter handle or anything, or
just at options_insight. I'm pretty active on Twitter, putting various things out there. And if you are interested in crypto, I've got a crypto weekly podcast that I do called Crypto Options Unplugged. It's sponsored by the biggest crypto options exchange on the planet called Deribit. And so if you want to understand what's happening in the world of crypto and crypto vol specifically, then check that out as well.
That's awesome. Well, Imran, it was really a pleasure getting to know you, and thank you very much for your time.
No, you too, man. Really good to catch up.
All right, it's our pleasure to welcome to the show Darren Dempsey. He is the founding partner of Harkster AI, and he is a former institutional FX trader. Darren, thanks for joining us.
Thanks, Kevin. Thank you for having me.
All right, so right away we're going to tell that you're not one of us in terms of a North American, and for those that are particularly astute, they will tell that you're also not kind of English. You are Irish. So tell us a little bit about your background. How does an Irish guy end up being an institutional FX trader?
So I guess the standard way most people kind of joined Wall Street, so the milk round. So 2006, 2007, started looking at jobs over in London. Decided that Lehman Brothers was the right place to be at the time, and had a fantastic experience for the first year and a half of my career to kind of join. Really good team, all really good friends now. And you know they.
So this is in New York. You went like this was this?
No, straight to London. So I graduated out of college in 2007. 4 or 5 weeks later, after a quick trip to Greece and some other places students go. Yeah, came to
you
London
were trying to find yourself, and you said, "Oh, I'm not in Greece. Maybe I'm in Italy."
It was too warm. I couldn't find the sun cream. It was time to go somewhere a little cooler.
So what did you study in university that you were able to get this job on Wall Street?
I studied mechanical engineering.
Oh, so not Wall Street, actually, in terms of, what do you guys call it again? Is it Bond Street?
Well, Canary Wharf, I guess.
Canary Wharf, okay.
Canary Wharf, yeah.
So you were
quite have the same branding.
In mechanical engineer, and so that's quite a different choice in terms of getting into securities. How did that come about? Like what?
No, I think most, and we'll go on to talk about it now, but I think the graduate that banks look for is, not just kind of commerce graduates or finance graduates. They look for a broad skill set, and most college degrees are really just about graduating, and it's actually showing that you can study, showing what you can learn, and then it's basically when you get on the job, how you're going to communicate, how you're going to be part of a team, and having a decent-ish kind of student sports career also helps. So if you show both sides of an ability to be a team player and learn on the job, I mean, not having finances is not really a problem when you come over to the banks.
Well, that's interesting. And you mentioned sports. Like, what sports did you play?
Well, football, or soccer, as you'd call it over in North America. Yeah, Gaelic football, which would have been the Irish traditional sport.
Oh, okay. And how does that differ from kind of rugby?
Gaelic football would be closer to Aussie rules.
Okay.
So 15 players, and it's kind of one person marks, two people mark each other, man against man. And then, it's kicking out of the hand rather than on the ground like soccer.
And where did you go to school? Were you in Ireland, or were you in the UK?
Trinity College. So I graduated out of Trinity in 2006.
Oh, you did? Okay. And so so the little I know about Trinity College is from Normal People. Normal, is that the name of the movie? Did you see that? Normal People, or the series and stuff like that?
Yeah.
Was that your, they would have been earlier than you though, right?
Normal People.
It was with the new actor that all the women love. What's his name?
Gladiator 2.
Yeah, what's his name?
Paul Mescal.
Paul Mescal. That's right. Yeah. That's all I know about it. Now, did you watch it? Is that what it was?
I haven't actually watched it. I know.
Oh my God, what kind of Irishman are you?
Probably spend too much time chasing the kids around and watching sports.
Okay, so
watching NFL.
That's right. So you graduate from Trinity and you head off to Canary Wharf to work in FX right away. Like, is that where you
straight into FX? Yeah, straight onto G10 FX spot desk.
And there you actually got hired by somebody that is famous in the FinTwit community, right? Was that right away? Like, did you work? Why don't you tell people who it was and where?
Brent Donnelly would have worked out of New York. So I worked in London for James Pearson, and Brent would have been equivalent to James from the New York side.
So you were doing something similar, and so you were on the FX market making desk?
Yeah, so G10 for the first year and a half until Lehman obviously closed. But it was a fantastic environment to learn. Still learning from Brent today, even 15, 17 years later. And yeah, there's some. I think
Sorry, I was going to say, I didn't mean to interrupt. I say we were chatting a little bit about markets before we started, and you started telling me your opinions about what's going to happen. I said, Jesus, you sound just like Brent. And we were laughing because your time frame is very much similar to Brent's. So kind of maybe you could explain to people that being exposed to that environment and being forced to trade in that environment, how it sets upon you for the rest of your career.
Well, I guess if you can kind of be given a position at any time from a client, you need to be kind of constantly looking at every pip, being able to react, being able to feel like if there's, a vol event coming that you're going to have to clear the risk quickly, or if you can kind of hold a position for a few hours and work through it, and G10 vols down at 4, you can take something on for an afternoon, or and build a basket around it. So it's all about knowing effectively what you're going to do as soon as that risk gets transferred, and that builds a kind of a completely different skill set naturally to someone who can take a 3-month view or a 6-month view or a 2-year view and just hold, and the percentage swings there don't necessarily matter. And the same way as if you got a client position and you held it for 1% and you only charged 5-8 basis points to get into it, you're going to have conversations with your management quite quickly. So it breeds a different type of trader and how they interact with the market, what they look at in terms of pips and it's short-term drivers.
And how much of it, like, I know Brent is a big kind of correlation trader. Like he'll go and, like, let's just take Canada for example. If you were trading Canada, one of the things that it moves with is with oil. How many times would you guys on those sorts of desks immediately offset some of it with the correlation of something that moves with it, or maybe even rates? Or would it just be something that
very few traders would have had the mandate to trade cross asset?
Right.
So in an ideal world, if you took down a dollar CAD trade, you could do the opposite view in oil and copper. Copper probably has a higher correlation at times than oil.
Oh, I didn't realize that.
With dollar CAD, one of Brent's hat tips.
Okay.
But if you took down, say, for instance, a Euro Poland position, you could basketize it with regional, correlations, Euro Huff, Euro Czech, Euro Noki, and so on. So you bring it to kind of its relative pairs and its cousins. And it's something quite interesting. Like the night I traded the TCMB emergency hike, when they did 2%, dollar rand moved just as much as dollar Turkey. Because all the machines will chase dollar rand, or all the hedgers, if you can't get out of dollar Turkey, you'll buy something around. So you'll always see around these events kind of correlated pairs trade, because that's where you de-risk as quick as possible if you can't actually go source liquidity in the pair that you've made a market in.
All right. So the reality is that they're not actually going to these other cross asset things, but it's definitely affecting the other currencies that have traditionally moved with it.
Yeah. And, people have built, if a dollar headline comes out, I want to sell $200, and they'll have a, big red button on their desk, and they can sell a basket of currency pairs against the dollar, whether it's, straight away without having to go into each section. So all these things can become automated, but in terms of risk management, it's very rare that you'd be able to take a position in a different asset. But most certainly within FX, people will be making baskets around the kind of the larger trades that they would have made a price in.
Okay, so let's explore that a little bit. You said like that. Are you talking that today, or is this back in the day that dealers would have that? Because dealers are the ones getting slammed with those positions from the clients, right?
Yeah.
So you're saying that your clients would sit there, and even like today, if they see something happen, they'll quickly hit a button and it'll just be like sell a basket of predetermined currencies to express a view on the dollar?
Yeah, with the advent of technology, and originally maybe 15 years ago, you had kind of the standard EBS and various tools or Reuters, but as kind of technology teams and budgets built out in all the sell side banks, and they also built their own tools to market to clients. You ask Brent what's his wish list. He'd say, like, if there's a Powell headline and he's hawkish, I want to buy $200, and then you set your parameters of I want to buy $50 yen because it's correlated to US rates, or I want to sell 25 euro dollar, and so on. So set a parameter of how far you can go, to 20 basis points, 30 basis points away from current when you press the signal,
Right.
And go from there. So those baskets can kind of be quite quickly put on rather than individually working through. And then by the time you get to your fifth pair, well, you're a minute gone past the headline and the trade may have already happened.
So now that's how it would have changed in those times, because when you came onto the desk in 08 or so 07, that would have still been all verbal mostly, wouldn't it? Especially on the larger size.
It was already starting to change.
Oh, it had. Okay.
Yeah, it had already started. It wasn't necessarily fully fully kind of worked out, but it was definitely already changing. And the big, Barclays, Deutsche Bank, so Barks, Autobahn, City Velocity, JP Morgan Execute, they were already starting to kind of take in larger market share and be much bigger books.
So would today, like an institutional FX trader, do almost all of their trading exclusively electronically?
Yes.
Oh, okay. So it is a screen world now.
Yes, 100%. And that would have accelerated after COVID. The many people that hadn't fully kind of joined the electronic world and still like to trade voice.
Yeah.
They actually found that if Darren's sitting in Southwest London, they're trying to contact a salesperson maybe in Canary Wharf or further out east, who's trying to get Darren in his house for a price and then back again. The pace was too slow. That if they had a tool in front of them that they could trade on straight away, the risk was transferred. So COVID definitely accelerated the EFX kind of, or the machine pricing.
It kind of takes all the fun out of interventions, though, doesn't it? Because like I've always thought that the greatest job in the world is to be the guy that says, like when the Bank of Japan phones up and says, what's your market on like a yard or whatever a big number is of yen, and you have to sit there and figure, okay, they're going to hit me and this is going to really move the market. How do the interventions work now?
It's a very polite way of putting it.
How do the interventions work? Do you think that the Bank of Japan, when they're doing it, are also doing electronically, or do you think that they are still old school, phoning up Nomura and saying, checking rates kind of verbally?
Well, checking rates is different to actually.
Right. But when they go to hit it, is it like when they're so actually there's a question for you. What do they mean when they're checking rates? Aren't they just asking for markets? Or is it
exactly? So they're not actually trading. They're just checking rates to kind of possibly send a signal that we're watching.
Yeah.
Or we're aware of where dollar yen is. We're not too happy. It may have reached our threshold of a 10 big figure move in a month. But really it comes down to credit lines. Who can they actually trade with and where? So if they do a desk themselves, or if they actually go to some of the mega banks, then they probably do a mix of both.
Okay. All right. So let's talk a little bit about the markets, because there's a lot going on. And so you're obviously an FX specialist, and we're eventually going to get to your product that is for a lot more than just FX. But before you do that, I'd love to kind of pick your brain about what you think is happening here and kind of what you think you could see in the next month.
Well, obviously Trump has been the biggest game changer over the last few weeks, and the trend has been set straight away. Everyone went back to their 2016 playbook.
Right.
But if you take, Europe in particular, it's become the per cousin. 1% growth forecast for next year, aggressive. ECB may do 50 basis points in December, and they're losing on all fronts. America has AI, has Silicon Valley, it has Trump, has protectionist policies. It's exceptional again, 3 or 4% growth. And then on the other side, you have China, who now have electric vehicles that have undercut, German manufacturing at a time when Chinese demand is also dropping and tariffs may come in on top. So Europe's kind of struggling, and that's even before you get to the UK. But where does the positive news come from? And it may not be. It's December is normally not a time to kind of fight trends, and the allocation of money will continue to go to the US and the exceptional team. And there is no real reason at the moment to kind of think that Europe's going to bottom out between the French potentially having, the government falls again, oats have already blown out. And then in Germany, you have the fiscal situation cannot come until after the election. So where is the positivity of growth, fiscal, or yield support for the single currency? It's not necessarily a crisis like we saw in 2012, but the trend will be there to allocate away from Europe because they're just stagnant growth for the foreseeable future.
One of the things about currencies is they do trend a lot more. So like I hear you say all these things and I'm like, oh geez, well, almost like all the bad news is in, like it must be fully priced in, but that's often not the case, right? Like currencies seem to go with that, like they set it in motion, a trend, and it just continues and continues and continues. Any kind of insights in terms of why that is?
It becomes the end user. So, if you look at equities or, people are trading for certain reasons, but if a company has to do something and a company's going to say a US company is going to need to hedge, then they're going to hedge and say their 6-month forecast is euro dollar lower. So therefore we'll go to the market and hedge. So it's the end users that continue to kind of express and send these moves further, drift in trend. And the interest rate differentials at the moment, the ECB, the divergence between kind of the ECB having to potentially now do 50 after the tariff threat, the recent PMI dip, the HICP, the wage data, there's a growing trend suddenly in the last kind of 4 weeks, not just the Trump effect, but actually ECB versus Fed. If we took the US elections away from it, we're talking about potentially the end of the Fed cycle, or maybe just 1 or 2 cuts left in the Fed versus ECB having to do at least 4 more. And again, where is that stimulus going to come from, or where is that growth going to come from in Europe if you have lower yields and only 1% growth? Because FX just follows growth. People invest in countries that are going to grow, and Europe is stagnant. And then, the UK, the policy mix here isn't much better in the UK.
I know you're much more of a trader, so I won't ask you what could potentially change to make it so that Europe actually does grow, because you're basically just looking at the next month and you don't really care, right? In terms of
fiscal, like if you ask anyone, it's whether it's stimulus out of China, and we have stimulus every month, or some sort of stimulus, but an actual big bang. Like it's always, you always got to be cognizant of like if there's a regime shift, and one is if the stimulus is a proper stimulus comes out of China, and we actually know that growth to China could be, for whatever reason, priced at 5%. If Germany or the EU did a fiscal relative to the Inflation Act in the US, of course, people will put money back into Europe. And then I guess the third one is maybe the tariffs that Trump brings in are not 10%. Maybe it was just a threat. And, the Chinese growth story just naturally improves and people will get squeezed in that regard. So there are big picture reasons why, but today sitting here, it's hard to see them coming in the next kind of 4 to 8 weeks.
All right, now let's talk a little bit about Brent's favorite currency, the yen, and if I'm not mistaken, he was the head yen trader, right, at Lehman during that period. Why don't you tell us a little bit about your opinion about what's happening there? And it is actually the only currency that's really bucking the trend since Trump. It's rallied on it, and does this all have to do with the worries that the Lighthizer kind of opinion that they need to revalue their currency upward, and the market's kind of running ahead of that?
Potentially. I mean, there were other reasons as well. Obviously, the old sell-off, if there's repatriations out of French debts, money was actually being brought back to JGBs. So it was a reason to kind of be short CAD yen, which Brent actually had quite well. And then, US yields are lower, following Besant, the 10-year tends to drop down to 4.2%. Another reason kind of for dollar yen to come lower. And naturally, if you look back over the last few years, the seasonals for the dollar are actually quite soft and if you have a lower move index, a lower fixed income as well. So it is booking the trend for now, but it's also, as we've kind of previously discussed, like where BOJ or where the Ministry of Finance, were they happy with dollar yen up at 155 all of a sudden after the 10 big figure moves? So there are reasons. There's two-way risk into the December Bank of Japan. Could they hike again after the Tokyo inflation overnight?
And so how much do you guys as currency traders look at the like purchasing power parity and like think about the kind of longer term cheap versus expensive currencies out there? Is that something that's in the back of your mind, but in reality you just can't let it influence your trading because it's probably just going to get you in trouble?
You can't, like, second to second, it doesn't work. You can have a view on it. Normally this time of year, it always comes out because people will be doing the year ahead forecasts and why this is, cheap. But, day to day, week to week, it doesn't come into it.
All right. Okay. So now let's talk a little bit about your new endeavor, because it is something that, I'm not I haven't embraced AI. I'm a little bit of an old guy and sitting there going, geez, you know what? I go into Chat GPT, I ask it some things. I'm like, that's wrong. It's, people tell me it's hallucinating. And I'm like, oh, geez. But you've found a way to kind of use AI in a much smarter fashion. And first of all, why don't you tell people about what your company is, how you got involved in it, and kind of just what you're attempting to accomplish?
So, two friends of mine from Stone Milner. So I was at the hedge fund for 5 years, kind of started down this road to kind of filter, organize, and categorize all the research that comes into, a trading execution desk. So the problem you have is, and our market research shows that, some portfolio managers are trying to manage 500 emails a day. So it's humanly impossible now, the information overload, to kind of take in all the content and actually, consume it for the best of your ability. Obviously everybody tries, but on a quiet day we were finding people were only reading 20 to 30 emails versus the 500 that they receive. So we've set out to use AI. We've broken down kind of the macro research consumption process, and we've tried to add small productivity gains, labor productivity gains at each marginal step.
So one of the things that I found kind of fascinating as we went over it before was that, one of the problems with AI is that people just kind of unleash it on the entire world, and they use an entire kind of the data set is too large. Why don't you tell people in terms of what you guys do in terms of the data set and why that makes a difference?
So we separate, your research from your corporate communications. So if I'm organizing a holiday to Canada, but I also want to kind of research my short CAD view, I don't want my flight details to turn up in my CAD trading. So
right.
we quite quickly, if you segregate your research and that becomes your data set, so you lock down, you clean your data set. It also improves IP protection. It also improves privacy, but you end up kind of, we lock down the research content with our own finance prompts. It's like, the first week on a trading floor, we all speak English, but we don't actually know the trading terminology. We don't know what like people mean with mine, yours, or two-step steepeners. So in the same way as, a large language model is kind of trained for the everything that's going to happen in the whole World Wide Web, whereas we're actually going to, we lock it down and we focus it just on finance prompts. So we ask questions like an execution trader would or a portfolio manager would, and that's actually what we extract. So rather than using kind of what's being trained for the broader market, we actually target it at just the finance data sector and pull extracts from that.
All right. So it's fascinating. I think we're going to get you to pull up your screen and share with us, and maybe you could walk us through kind of what this looks like and how this works. And actually, before we start, this is geared towards institutional clients. Is that correct?
Yes. So institutional clients, we build for every company gets their own segregated environment. We can host individuals in certain circumstances if they own the subscriptions, and they're private investors or high net worth investors. But those that sit within buy side or sell side firms, we work with that firm as a whole.
Right. So this is really geared towards that portfolio manager that, as you say, is getting in 500 pieces of research and is stuck trying to figure out, like, how do I, synthesize this down to what's really important? And your product is trying to solve that solution for them.
Exactly. So if you take this first email, we have two summaries. So the first form, everything in green is basically AI generated. And here, this is like what we call the contents. So, your subject headline in an old email system doesn't necessarily tell you what's in the full email, because it may only focus on one topic. It doesn't focus on all the topics. So we if for a quick scan, do I need to read this email? Do I have risk in the place, or am I interested in a theme? You can look at the kind of short form summary. We then expand the summary, and this becomes about 20 to 25% of the original email.
Right. I'm going to just read off because I think I also have this. So this is the Steno research.
Yeah.
And it just kind of like what you'll see is that this summary, it'll be like Fed plans to improve market liquidity by December. And then you go through and they give you a paragraph on that. And then they go, China moves away from gold as a strategic reserve. Then manufacturing momentum continues to outrun services. U.S. equity positioning approaches stretch levels. And then finally, portfolio adjustments amid market conditions. So very quickly, you've put this into something that is like 5 quick paragraphs that summarized what this long piece of research does and enables people to decide, maybe they do go and read the whole thing, or maybe that's good enough.
Exactly. So you consume more and, you miss less. So, people that, are skim reading research, you're skim reading your inbox just to get a feel of what's out there. And then you always try and go back to that one that you'd like to read. Whereas, if you're reading 20 to 25% of the original content, in theory, if you spend the same time, you can read 3 to 4 times as much research.
And so just to understand kind of the logistics of how this works is like you get your own, how does the emails come into a potential new client? Let's imagine that Fidelity's portfolio manager phones you up and says, listen, I'm very excited about this. This sounds like it's just exactly what I want. How would you guys set it up?
So they get a Harkster email address, and then that gets added to distribute their current distributions. This distribution list, they can flip it across.
Okay, so they would get their own Harkster email address, and so that would be like a separate inbox that they would actually go and log into to see all the research.
Exactly. And again, we have to segregate that for IP reasons. And, the key thing for our tool is it becomes a secure gateway to an LMM. So if you're, originally, as soon as kind of ChatGPT or all the various LMMs became available, everybody had them on their browser. Everybody was enjoying, summarizing. We were talking to people that were basically copying and pasting documents into retail LMMs to get summaries, which is kind of one of our triggers along this process to build this company. We thought, why can't we automate it? But the key thing is to be a secure gateway. A lot of those tools have been taken away because they're being used to train. So our tool does not train, does not retrain, and does not kind of store any of the data, which is quite important for IP protection for content providers.
Oh, I see. So this is actually meaning that the sell side doesn't want their research going somewhere that's sitting in a repository somewhere.
Exactly. So we can process it, and then it forgets it.
Okay, fair enough. So from that perspective, it kind of complies with the sell side research rules. And then also you're, back to that idea that the LLM is slightly different because you're only getting research. Is that correct?
Well, the LMM is just the base, but the large language model is the base that we use to generate the summaries.
Right.
But we basically wrap it in our prompts. So the finance prompts that we write to extract, so the AI system that I'm sure we'll go on to later, we basically use LMM in different ways, or AI in different ways, to kind of add each step. So whether it's vector search or the trade idea widget that we've built, where we just take out extract summaries from said email with, here's your trade idea. So you can just have it.
Why don't you walk us through some of those features?
So if you look at the trade idea, so the same email from Steno,
yep,
you just have a feed. So every email that comes in, we put it through a different process, and we just extract exactly what is said. So you can see quite quickly all the trade ideas that have come into your inbox. You don't have to scan for emails, don't have to look for certain things. You can just see this presentation is the various trades that have come in today into my inbox.
And so this would be all of them across all the email research that you received.
Exactly. And what we do is we have an inferred trade idea or an explicit trade idea, because invariably, a lot of portfolio managers want the nugget of like, a strategist thinks fair value for euro dollar is higher.
Yeah.
And then they'll go and look at, it actually is a higher. Should I reconsider my euro dollar position, my short euro dollar position? And they don't necessarily want to wait for a content provider to say, I'm now long euro dollar, my targets here, my stops here. It's actually the inferred ideas can sometimes be the best trade.
Okay, and your model can figure those out.
Yeah, so we basically toggle. So if top left-hand corner there, we can toggle between explicit ideas or inferred ideas. So you can actually, within the same feed, you can flip between the two. So if you only want explicit ideas, you can turn off the inferred quite quickly.
All right. And why don't you walk us through some of the other things? I see that there's filters by like specific subjects.
Yeah. So what we say, vector search. So in the old world, keyword search is just literally, search for euro. Anything with EUR, you find exactly that. But now with vector search and what the AI allows you is it's placed things on a grid and measures how things are semantically, how things are close. So you don't just have to look for euro, you can look for ECB and all the various things around euro that are actually relatively close to it.
Okay. And then what else? And then what other features did you want to highlight there?
So this search in particular, and given, the risk that everybody's kind of focused on the downside, and we mentioned euro dollar kind of drifting to new lows before the end of the year. In our search engine, we can actually bring back multiple emails into one piece. So you can search for euro, you get 3, 4, 5 sources, and they're referenced in the same piece on the right hand side.
All right. So is there anything else you wanted to show us while we have the screen up?
Yeah, I think the event risk calendar is actually my favorite. Okay. So my old job, we'd always have to know what events are coming up, how that will affect impact positions. What are we, should we what day should we buy options past? And so like the Tokyo CPI yesterday, obviously it's not something people probably naturally follow all the time. Right. But our event risk calendar, rather than printing off a calendar, working through your Outlook, looking for sources of, research around these kind of data points, you just click on our calendar, it searches your inbox, and it generates a report on that topic. So whether it's Tokyo CPI yesterday, USism on Monday, you can see quite quickly all the different data sources at the bottom that kind of writes you that report on the data event ahead.
Does it currently take PDFs or no? Are we not?
It does. Yeah.
Okay.
Yeah.
So if you're getting sent PDFs, there's no problems dealing with that.
Yeah. So Brent's piece today, this all came from the right-hand side, came from Brent's piece. So anything that is unprotected for a password, we can scan and summarize the same way as email content. Obviously, things that are behind a paywall link, we don't go and we can't extract.
Fair enough. Back to that same problem. So tell us a little bit about how the experience has been starting this company and what the feedback has been and kind of your kind of feelings about this so far.
It's very similar to trading. Some days you think you're really good at it, other days maybe not so much. But no, overall, I think people have the problem. People have too much information that they need to decipher and they need help. So it's almost like having your own desk assistant. An awful lot of my job was writing pieces or studying pieces and then relaying that information to the right people, CIOs or PMs. And this can just do it for you. Same way as, there's a catch-up tool in there as well. So if you're off desk for 3 hours, you can ask your inbox to give you what's come in over the past 3 hours and give you like thematically segregated inbox and a little report on all the topics that have come in. So it's just all a labor productivity gain that I think is needed. And people have been using AI or reading Fed minutes quite quickly and trading on it, whether it's black boxes, however. But now it's time to give it to the individual PM as well.
Well, that's really interesting. All right. Before I let you go, I put you on the spot with the normal people, and you hadn't seen it. So I'm gonna let you do something. I'm gonna say, since we were talking about Ireland, and you guys I know are music lovers. So give me your favorite Irish band or performer.
Favorite Irish band?
Yeah, or performer. Do you get booed if you say U2?
I know it's not the cool one to do, but
No, it's not the cool one to do.
It's not. But that's possibly more not so much music. It's probably other things. But yeah, I mean, I think you have to go for U2.
Okay,
or
so
the Cranberries, obviously with the rugby, the Cranberries, the Rugby World Cup, Dolores was kind of came back to fame over the last couple of years. So yeah, the Cranberries or U2.
okay, so you're showing your age there by the Cranberries. I love London. Dairy Girls. Have you seen that at least?
Yes, I have seen that.
Do you guys just kind of roll your eyes, or is that like actually what it's like?
I mean, it's documentary, I guess. Documentary. I'm not sure. I haven't spent too much time in there.
Yeah,
no,
okay.
I think, yeah. Sorry.
No problem. So listen, I don't want to send everyone your way because unfortunately you'll probably get inundated with tons of people that are excited about this. Who would you like to reach out to you that potentially kind of might be interested in doing this? Like, is institutional PMs, like, would you like somebody to contact you and learn more about this? Like what should we do here?
Absolutely. If drop me an email, Darren@Harkster.com. That's no problem. We're happy to. AI is quite a journey, and it's only at the start. As you said yourself, people are a little bit naturally the hallucinations and the different things that are coming. Whether we'll steal content or produce its own content in the future. My view is firmly we're decades away from that position. It's actually it's a tool to help, and it will actually it will emphasize and advertise really good content.
Right, and so you want only institutional clients though at this time?
Yes, please.
Yeah. So if you're an institution that's trying to struggle with the problem of too many research and trying to figure out a way to kind of put this through some sort of filter and are interested in contacting Darren. So it's Darren, DARREN at Harkster, HARKSTER.com.
Perfect.
And listen, if you got a website or something for everyone else, just to kind of go keep their eye on it, or are you guys on the Twitter?
Absolutely. Yeah, we have a Twitter page and a website.
Okay, so what is it? Harkster.com. Let me just pull this up. Yep, Harkster.com. And what about your Twitter handle? Why don't you tell people that?
Oh,
you're not. Darren, you're supposed to be ready with this. Let me have a look and see if you're Harkster.
It's Harkster HQ.
Harkster HQ. All right.
Sorry.
Darren, no problem, buddy. I'm just giving you a hard time. Anyways, listen, it's been a real pleasure getting to know you, and thank you very much for everything. And best of luck in the new endeavor.
Thanks very much for your time, Kevin.
Take care. All right, Patrick, it's time for talking charts. What do you got for us?
All right. Well, let's quickly just start off by reviewing the top three things we were watching 2 weeks ago. And number 3 was the US dollar index. And interesting price action. It did break all the way to 108. And it happened with the euro breaking below 105. So the currency markets have woken up, but it was a little bit stretched. And so now we're kind of seeing all the currency markets pause. We can talk about the US dollar yen when we get to the other charts, but but just when we're talking US dollar, we certainly have a US dollar primary bull trend in place. It's at key resistance levels. It was a little overbought, taking a break. You have to assume the US dollar bulls will give it another go to break it to fresh highs. I mean, there's an argument to be made that we could see parity again on that to euro in the coming period. So this is something I think was going to stay on our watch list for the weeks to come.
Okay. What about number 2?
Number 2, will the Trump rally fade? Well, the fade lasted a whole week. And we find the S&P trading right back up at its highs. Obviously, it's like when we say the Trump rally, well, I guess the US dollar rally did fade a little bit off of its highs. but the equity market nonetheless is right back up along there, ready to go. And it looks like it's going to make another stab for clearing 6,000 and staying there. Like maybe 61, 6,200 can happen. I think at some point this rally is going to fizzle out and there's going to be a proper correction. But right now, the price action is still very accumulative, and I guess seasonality and flows are all kind of going to potentially keep this going. But the big question, of course, well, we'll talk about the top 3 things to watch in the upcoming weeks because that could all play into it. But number 1 was Nvidia.
Yeah,
right.
it's been a while, I guess, since we met. So that was like a couple of weeks ago. People have almost forgotten about it, but it was a big deal at the time.
It was. And you know what's interesting? Like it was worked up to be such a big market mover that it is only fitting that it opened flat on the
like yes, you're right. But it traded.
No, listen, the price action after, I'm talking about the earnings gap, like the actual reaction in the overnight price action is when everyone's like, oh, it's going to go 10, like it was pricing in like a $10, $12 one standard deviation move higher or lower. Like it was being priced for some sort of a big swing. And it was a nothing burger in terms of the initial after hours price action.
Yeah. Kenny G wins again.
Yeah. And, but very interesting the way it did break to a higher high. The first impulse was that break to that higher high. That's the buyers were like, okay, well, if it's not going to sell off, then we got the green light ahead. It prairie dogs that high and is trading right back down to that 50-day moving average here. What's interesting is with the semiconductors as an aggregate kind of rolling over, like when you look at the SMH index as an ETF, this is a space that's getting no flows all of a sudden. Like this is going into financials, it's going into small caps, it's going into all sorts of areas. It's not going in the semis. And so the bigger question is this going to be a bigger turning point for Nvidia? Like, is this is the rally? Then I don't want to already say that's going to sell off, but you know, this thing was a big part of the leadership going higher, and it was where everyone's attention was. Does this thing now take a break and just become, you know, in some sort of meat grinder trade range and just not take the flows?
Well, I suspect so. And not only that, when you look at that SMH, like I am no technician, as you know, but even I can tell that doesn't look like a good looking chart.
No, it's like all the rallies fade. It's heavy. It's
went
rolling
below
over.
Went below the 50-day. It broke below. It tried to rally up. It was stopped there.
Yeah.
This looks like to me
at 235. It did stop right at the fib retracement. You can't. I don't want to already put nails in the coffin. But I would rather conclude that this isn't a place that's no one's interested in right now. There's no money flowing here right now. I wouldn't want to make a bearish call on this yet, because I think the whole market needs to be selling in order for the semis to really take a dump. I think right now they're just not going to take the flow. And so I think that they're going to be far more range bound, far more boring, and disappoint of a lot of investors that were previously there for momentum.
Well, I would argue that the Mag 7 has lost its leadership from 3 months ago. This is one of the things that I've been arguing, is that the rally is widening out. It's moving into a lot of different things. We're seeing equal weight doing better. We're seeing small caps and mid caps doing better.
I would love to talk about these Mag 7s.
Okay, let's go though. Before we do that, let's do the 3 things we're watching next week.
Exactly. So number 3, the inflation numbers are coming out. I mean, the inflation numbers have not been a big market mover in the last couple months. They've been more or less coming in line, and the market isn't until the market gets a big shocker. I don't think that these are the big market movers. And more importantly, in order to get a high inflation print, I think we'd have to see things like oil prices moving and gasoline and other things. And these things are just pinned to the bottom. They're just not drivers in there. The U.S. dollar's strong. Now, a lot of these things are not. I think it would be an outlier for there to be a high print on the inflation number.
I'm going to push back a little bit, and I will agree that on the whole, the excitement that we saw from 2 years ago is gone. Like we were seeing monster beats in terms of inflation, and it was very volatile in terms of the responses. Having said that, I think that you'll go and if you look at forward inflation, it's been rallying a lot, meaning kind of a 1 year forward swap of inflation. It's been rallying a lot on concerns that Trump is going to run the economy hot and might do the tariffs. And although I agree that we're not going to see something dramatic on this one realized print, if it ends up even being a little bit higher than people expect, it could be that combined with forward inflation rallying might be a little bit of a wake-up call. So I'm going to say that inflation's becoming a concern again. And it would be, in terms of the bulls, I think it would be very helpful if we kind of saw a week or at least an inline inflation number, and they could kind of breathe a little bit of sigh of relief. But if we get even a slightly higher than expected inflation number, I think people could be extrapolating a lot from it. So I think that the stakes are a little higher than usual.
I don't want to push back on your thing. I just think that that's a 2025 story. I think that this December number that's going to come out is more likely than not the one that's going to start the process. But your thesis is like come January and 2025 story. I get it. It's on the table 100%.
I think I'd almost say though that all inflation numbers, given this worry about Trump and about the tariffs, are going to be more scrutinized than usual.
Yeah. So number 2, the jobs numbers.
Yeah, it's always a big deal.
It's well, you know what? They've kind of been there, and Nvidia was a big deal too. But jobs numbers have been a big deal, but we're now in a situation where, if there was going to be a crack, this is a place where the market could be surprised. And I know you did some sort of a chart in your newsletter that we were showing that the market's implieds on that day are actually quite high in anticipation of that jobs number. So there's definitely room for the jobs number to create some intraday volatility. The bigger question is, will it surprise in a way that shows that the macro picture has shifted? And we haven't had any crazy misses on the jobs yet, at least not ones that stuck. I mean, there was always the outlier month, but it'll be interesting to see whether this one is the kind of market mover that everyone's starting to think it could be.
You know what I would find interesting, Patrick, is the other day I was pulling up a chart of economists and strategists' expectations of a chance of a recession in the next 1 year. And remember a year ago or a year and a half ago, how sure everyone was there was going to be a recession,
including me.
It was for sure. And it was actually one of the highest levels of responses that there was going to be a recession that we had seen in decades over the next year.
And what is it now?
Well, now it's back down to almost nothing. Nobody's expecting a recession. Everyone's so sure.
Isn't it funny how that always works? It's like it's a kind of a reaction function to like it's hard to be bearish or say something like a recession when the stock market's doing so well and a couple of these numbers.
Oh, but the stock market was doing well then too. I think it was just this narrative that, and I don't know if it's like, I agree with you that it is difficult to be against the herd. And I think that the herd became convinced that there was going to be a recession. And if you got up and you said, you know, there's going to be no recession, you were labeled a fool that didn't understand how tough it was out there. And I think now we're almost in the opposite situation.
No.
And one of the things that I always highlight is, we can sit around and debate whether this is going to happen or not, but that's just part of the whole thing about trading. It's not just predicting what's going to happen. It's what you get paid if you're right or wrong. And one of the things that I argued back then was that even if you guys got your recession, it didn't matter because it was almost fully in the price of the securities. And so I would I would almost say now we're almost in the exact opposite situation.
Yeah.
Sir, go ahead.
No, I'm just gonna say, like, go back, and not that I think that this is gonna be an analog of 2007, 2008, but that's the last time we had a Fed rate hike cycle of similar magnitude. And it was Bernanke stopped raising rates in the summer of 2007. The recession didn't come in until mid 2008, and so you had a scenario where there was a lag time where they were cutting rates for an entire year before the recession got nasty. The point is that everyone that was looking for a recession during the rate hike cycle earlier this year, and now they've given up on the thesis exactly when the window of this kind of thing could actually materialize. I think there's more risk in 2025 than the market's pricing.
And I going back to the jobs numbers, which is the second thing we're saying that you should watch over the next couple of weeks. If you were to get a surprise, meaning that if we did have an uptick, the market is not ready for it. So if they come in line and they come in strong, nobody's going to be surprised. Everyone's going to be, yeah, for sure. I understand that. Having said that, if it is the other way around, then it pays off. So I think that we're increasingly at a point where even if the economy performs well in the coming months, quarters, year, it's increasingly all priced into the market.
Yeah. And
number one thing we're watching next week.
Will Bitcoin go to 100,000?
Now, for those who don't know, Patrick said he was actually asking me this time about the top three things, and I said you got to put Bitcoin in there because everyone's watching it, baby. It's the most important thing out there. It's what the regards on Reddit are focused on, and that is what that's all that matters. So it's true. It's all that matters, Patrick.
Okay. Well, you know what? The interesting part is it's hard. You can't, for all of our jokes and the fact that we're both no coiners, foolish no coiners. We clearly left so much money on the table.
Do you know what we call? You know what Michael Saylor calls no coiners?
What?
Poor.
Oh my God.
Listen, if you guys want to listen to a really catchy EDM dance tune, Google Michael Saylor. We call them poor. It's actually it's really catchy. It's really well done. It's really, really well done.
Okay.
There's a reason that Michael Saylor's MSTR is trading at 3 times NAV. He's got great tunes.
There you go.
So what do you think? Do we hit 100,000 this?
Right now, okay, technically, when you there's no reason to bet against it because you are already at 98,000. It's literally within a daily range standard deviation for it to print 100,000. So to kind of like say, oh, is 100,000 like 100,000's within a stone throw? Just
fair enough. Just realistically, we're going to hit it just because of the odds favor.
We're so close.
So then the real question is, here's the next question. When we hit 100, given that so many people are watching it, what do we do from there? Do we run? Or do we prairie dog?
There is always the possibility of a double top. But whenever any security retests its previous highs, there's always a resistance level that could bring about distribution. But on balance of probabilities of the way that the price action is behaving, which is we had a 5-day sell-off that did not even come close to a Fibonacci retrace of the previous moves. It got bought on dip very, very quickly, got right back to the highs within days. This is a market that is taking flow, that is being well accumulated. It's being bulled, and betting that somehow the bears will just randomly show up and that sentiment will shift and everyone's going to hit the sell button. You have to give the bulls the benefit of the doubt. I think that they might even take it to 110,000. Like there's no reason to be betting bearish yet.
Okay.
When the price action looks like it's peaked out and some distribution signs and things get heavy, we can talk more bearishly. But right now, just the way the price is behaving, I don't see any reason to make that call now.
All right. I have no view except for its madness.
It is at its previous high, and that is that the only thing that a bear could hold on to right now is a double top retest. So let's see. All right, so that is the top three. Let's just actually jump and talk charts. Okay,
Okay.
right off the bat, S&P 500 trading along its 52-week high or all-time high, and there's not much reason to not believe that the S&P can still muster up a rally to 6,200 as this kind of upwards channel. Look at me pulling out the crayons here.
Nice.
Do you like the red color? Is this a good one?
No, you shouldn't use bad luck.
There is it?
Yeah, it's
Okay,
like you shouldn't have red colors on the trading desk. You shouldn't have if there's like a penny in the urinal, you should stay away from that. It's true. That's why I was in Chicago and I was there and they were like, don't use the East bathroom. And I'm like, why? Like this, like I thought, somebody had died and there was like, and they're like, there's a penny in the urinal.
Okay.
That's a true story. I am not making this stuff up. That is a true story.
There you go. Like, you got to be a little bit superstitious.
Yeah.
What I was just going to point out, the path of least resistance is still like, I mean, literally it's funny that S&P is right at that kind of double top point that Bitcoin is, which is like, it could reject along its previous high, but there's at this point with the next kind of major news point being the jobs numbers on Friday. I mean, what will the market stay pinned right along this high for entire 5 days before the jobs numbers turn out? I still think there's plenty of room for the market to go to 6,100 or something. Maybe now the jobs number could be a turn point, but I mean, we're going to find out next Friday. That's the whole point of watching it as a key thing to watch next week. The interesting thing, you keep talking about the equal weight index, and you're bang on in that this has been materially outperforming in a sense that it already broke to a fresh new high. It's already following through. We're continuing to see that equal weight index do incredibly well. In addition to that, Kev, the Russell as well has at least attempted to break to a higher high. At this point, 2,500 to 2,550 is a very natural place for the Russell to crawl higher. So the market's next week into the jobs numbers crawling higher. There's not much reason to fight against that thesis. It's the path of least resistance. It's been the trend that's been in place. I think the next kind of turn point would be as if the jobs number surprised everyone. So
can I jump in here with my thoughts?
Mm-hmm.
Although I am bearish Mag 7 and nothing would please me more than the market's shitting the bed. I actually think that JP Morgan option whale, he sold the 50-60 or sorry, my dyslexia is kicking in, 60-50 or the 60-55 on the S&P 6,055 strike.
Yeah.
And that's a December 31st. I think that thing tractor beams for the next month. I think that we end the year at at that thing, basically right at the money. It's going to go out. It won't finish in the money, but it'll be right there. And the other thing that I did was I actually included this in my chat the other day. And for anyone that is interested, go to the Macro Tourist Substack and then click on chat and you can see it. I included a chart that shows 2021 versus the current environment. And Patrick, we're in a situation where we're almost replaying that, note for note. Really? And if you remember back to 2021, we rolled over on Jan 1. So I'm increasingly of the opinion that you shouldn't overthink this. It's going to be a repeat of 2021. And the only thing I will say is that
you're talking about this price action right over here.
I'm talking about the whole year. We're almost up exactly the same amount. It's almost the exact same looking chart.
But here we are like here we are like at the start of December back over here, retesting the previous highs.
Yeah.
A quick little dip, a break to higher highs. And it wasn't until the first days of January where it rolled over bang on. Like you're pretty much, it really does feel like that. I get it. And to be honest, if we see a scenario where even if the jobs numbers did bring in 100 S&P point drop, like just like a quick reaction, and then your tractor beam theory plays out, if after that, I mean, what, the FOMC is going to move the market? Like Powell at this moment, I mean, what would he have to say in order for, and why would he say it in order for him to be a big market mover in the middle of December? I think it's entirely possible that if the jobs numbers don't create a big market move, that your theory can be exactly the one that plays out, and that we just have a holiday season pinning where low volumes, everyone says it's been a great year. They're just going to kind of coast into the end of the year for to lock in their returns. And like, I mean, maybe there'll be a little bit of selling here and there, but overall, we may have to be waiting to January for things to liven up.
Yeah. And the other thing is that I was listening to Jim Carson the other day, and he highlighted how there's actually, although volatility is well supplied in the kind of index space on the Russell 2000, the small caps, the volatility, the dealers are actually short gamma. So if I was to pick something that might scream into year end, even though small caps have gone a long way, that would be my pick.
I don't think they've gone a long way. I mean, they've gone a long way on that 1 day gap.
Yeah.
But when you really step back and look at the chart, I mean, is it out of line for small caps to do something like this for the rest of the year? Like,
I could be even more.
It could be, but I'm just saying, like, I'm not going to push back on it. Like, I don't think this is an overbought chart that looks like it's imminently going to have the feet kicked out from underneath it.
Fair enough. And then I think the fact that dealers are short gamma, it's going to mean that the potential for a squeeze is there.
But look at the way the NASDAQ is heavy. Like, it just hasn't made it back up to the highs. It's being dragged down. Let's go through the mags. Let's start off with Apple. Now, Apple did make it back towards its highs, and this could be an ascending triangle pattern that could push Apple higher. I mean, it's probably, I wouldn't say anything bearish about this chart other than it's trading along previous highs, which is always a resistance level that could reject the stock. But a sequence of higher lows, working its way higher. Dips are very short term in terms of 3-day quick dips and immediately bought. So this is still getting some love on the short term, right? The one that's been stuck in the mud has been Microsoft. Like now, if you look here, Microsoft is grinding it out right in the dead center of this trade range. It just is stuck. It can't do nothing. And this is where things are grinding. But then you take the other grinder, which is Google, with all this antitrust stuff going on. It attempted to break out on earnings and fell right back down into the trade range from September, October, once they got involved into antitrust stuff. And so this is certainly not taking good flows right now. And so what is? Well, Amazon had a nice earnings beat, broke to 52-week highs. It was a beautiful Fibonacci retrace straight to its 50-day moving average, turning right back up. Amazon, though, if you think about it, Amazon's actually the biggest component inside, or the second, is it the second biggest or biggest component inside the consumer discretionary ETF?
I think it's the biggest one. It's the biggest one.
It and Tesla are both 20%. Like, one of them is just a little bit bigger than the other in terms of weighting. But it's in there.
Look, do you know what the actual
XLY?
XLY. Let me just pull it up here and go members. They do have some weird rules on these spider selector.
Yeah.
Oh yeah, no, Amazon's double, or not double, 22% on Amazon, 17% on Tesla. So
yeah.
This is the problem with these
ETF, like 20% weighting in one freaking stock, and 40% in two.
And it trades, and
like,
it trades
that's not
more like a tech stock than it trades like an actual consumer discretionary. I get it. There's a big component of it that it is a retail consumer stock. But having said that, AWS is what's really driving, the valuation of this thing.
Fair enough. But the bottom line is that when people are sector rotating and they're sector rotating, let's say, out of semiconductors, and they're so going into the things that are working, then financials and consumer discretionaries are ones that are getting love, right?
Yeah.
And so money is coming in there, and those that are using this ETF are feeding Amazon, right? Like
enough.
it's taking some in there, right? Now, well, we might as well look at Tesla as well. Now, overall, obviously, Tesla got a little bit overshot, but when you look at the chart of where its previous major high was near 400, hard to say that it's just going to randomly stop here at 350 at this stage with this kind of momentum. The idea that it could go and print back to 2021 highs near 400, which is not a crazy call. That's a 10% advance, right? Like, I still think it's entirely possible that Tesla can still follow through a little bit, especially the big tell will be right now because it had a little 2-3 day pullback. If this pullback is bought on dip, then that right here, and let's say stays above 3.25, then 400 is still on the table here. The interesting thing is when you go to Meta still doesn't look bearish. Like this entire, while it has sort of stopped going up and it's been stuck in this range, this still, like all of what are its previous highs act as support. It's holding above all its Fibonacci's. It's right along its 50-day moving average. If this thing here in any way breaks out above a thick crayon line, this thing could still have another go. And so I know you are kind of like shitting on Mag 7s, but other than Microsoft and Google, the other ones still have the possibility of contributing to a bull advance. And maybe they won't outperform. Maybe they'll be a market performer or maybe even an underperformer, but they still might actually go up some of these components during another advance in the market.
Yeah, I'm not disagreeing, Patrick. I'm fully prepared for my position to go against me. I'm just worried that I don't want to miss it.
Are you short the mags?
Oh, of course, I'm short the Mag 7s.
Okay, but you're doing it as a pair trade, right? Like a long.
Well, it depends on where I.
Are you doing that against the Russell or something?
Yeah, well, that's generally my theme is to own small caps, mid caps, financials against short these Mag 7s. It's finally starting to work. It's not going. The Mag 7s really
pair trading makes sense.
Yeah, but
I don't think there's a ripping upside to the Mag 7. Even if they all have an impulse higher, they probably will be like a beta 1 to the S&P in terms of what they do.
Yeah, I like, to be fair, Patrick, I'm leaning short here, even though I do expect us to rally into the year end. I'm more scared about the fact that it seems to be there's a fair amount of enthusiasm built into the prices. And so I'm prepared for the rally and I'm prepared to sit through it, but I am leaning short.
It's funny you say that because, like I've been obviously taking pot shots of being short this market numerous times throughout the year. And it's one of those scenarios where one of my ways to hedge it out is I take some longer dated puts out on the S&P, but I'll turn them temporarily into debit spreads to just bring down the costs and the carry costs during the period where these things are grinding. It's one of these scenarios where, you have to be patient because it is probably a 2025 story.
Yeah,
it is.
I am prepared for that. Like, and that is how I'm steeling myself in terms of expecting the next month to rally, and I'm prepared for that. And at the same time, I look at that kind of call that I have and saying that the S&P can rally another, to 60, 55. And I'm like, that's not that far up, really. Like, that doesn't really, like, in terms of the index, what is the index at 6,000? Let's just pull the actual, where is the actual,
what?
Because don't forget, so we're at 60.26. So I think that at this point we're, almost fully baked in. I think that the amount of gamma that is created from that option from the JP Morgan whale, it's gonna cause it to just settle down, and it's gonna be right around here. So yeah,
the only issue is if you're putting it on with options, you have the carry, like just the time burn.
Yeah.
So like you have to, yeah, if you're carrying it with an outright short, then that's probably easier to carry here than having, because like it's possible that if there's pinning that we might see a 12 handle on the VIX while we going into the holiday season, and then on top of that you throw in a couple weeks of time decay, and you might end up losing 10-15% premium on the carry.
100%. I do
Right.
not disagree. And that's though my reason why that I'm more comfortable just being outright short, because I think that the upside is limited on that actual S&P because of that big amount of gamma that we have in here.
Yeah.
And although at the same time, I love the long on the small caps because the dealers are short gamma there. So if we do get some movement and people start going into that sector, I think it could feed on itself. I really think that we might be surprised. S&P and Mag 7 goes nowhere for the next month. And a lot of the things that people are underweight scream.
Yeah. By the way, so like this is the XLF, obviously the leadership that's we've seen. The financials have been getting a lot of love. My big thing here is that I'm not going to push back that these are running, and I'm not going to push back that they can even still go higher. But how much higher? Like, can we see 53 on the XLF? Yes. But like, is this thing going to 60 or 70? I'm not, so here to me, we're talking about like a 5%, maybe a 10% upside. And I think 10% is even pushing it. But I don't think there's an immediate reason for it to go down. So I wouldn't want to be short the financials. I'm just like thinking, okay, when, somebody putting brand new money to work, well, shit, if you didn't buy the financials back in the summer when the XLF was down in the low 40s, like coming in here and starting to buy at 52 because you're FOMOing about the fact that you weren't in, I think this is not an asymmetric time to be joining the party. I think that if they still can go higher, no reason to be bearish them. Just kind of like, is this really where new money should be put? I don't know.
But that's how I feel about the whole market. The whole market is extended and it's difficult to buy up here. And one thing about this XLF, Patrick, because I wrote a piece about this and I was quite surprised. Do you know what the number one biggest stock in that is?
Isn't it Berkshire?
Yeah. Like tell me that's a financial. Like I get it that it's a financial, but it's increasingly it's like Apple. Yeah. Right. And number two is JP Morgan, which is fine. But then the number 3 and 4, which contribute basically. No, there's two it's MasterCard and Visa.
Yeah, that's right.
So like,
and those aren't even banks.
Those aren't banks. So I came to the conclusion that XLF is not something you should look at if you are like me and expecting the deregulation of the Trump administration to cause a bank rally. And in fact, you got to start looking at the BKX index, or if you're really brave, you go buy the KRE index. And I think that those will outperform the XLF.
Yeah. No, I'm not. That's interesting. All right. So
what else you got?
Let's talk currency. So there's that US dollar temporarily printed to 108 on the Dixie, broke 2-year high, but now giving some back. But this is the kind of real tell right in here on the dollar index where, it might find support on a pullback. I think maybe we could even see the 105 level tested in here, but I think that this is going to prove to being a buy on dip. And so on the short term, we'll see where the support line comes in. But I'm buying dips here on the dollar. But the question becomes on which currency pairs. And this is where I think you wanted to talk about the yen. But before I do, I want to just highlight that euro broke below that 105 low from 2023. Like it really on a weekly chart has kind of opened the gate for a potential decline back to 2022 levels. Like, wouldn't that be something to see under parity again if the euro got down there? But pound sterling, had a pretty dramatic reversal in the last couple months on the downside, giving almost everything back. You have the US dollar CAD breaking temporarily to 141. And now trading above its multi-year highs. So the point is that against most currencies, the US dollar is actually looking pretty good. But the one that has been moving in a big way is the U.S. dollar yen, and credit to you, you've actually were calling for this to diverge and play a safe haven role. And it's been exactly the way you called it, at least for the last couple of weeks. You're looking like a rock star here. So I'd love to hear what you're thinking.
Even the blind squirrel finds an acorn every now and then.
Yeah.
So when I was on last, I actually mentioned that I had the currency guru had weighed in terms of the chances of a kind of intervention in terms of the currency markets. But then I hinted that I hadn't heard from the currency whisperer in a long time. And he was kind enough to actually email, and he's allowed me to read his comments. So the title is Bat Signal Received, and he's checking in. And he says, Kevin, I hope this fine note finds you well and your loved ones are well and the markets are treating you kindly. I was listening to the recent huddle with Le Shrub, which was fantastic. I completely agree. One of the best that we've had in a long, long time. Make sure you guys go back if you missed that to go listen to it. And he says, I thought I would check in as was hinted / suggested. Okay, remember, I was bullish yen at this time. He says, running the risk of getting you all jacked up on Mountain Dew, I am very much in agreement with you regarding the yen. I am very bullish. I currently have a small position, but my intention is to get much larger as circumstances dictate. Not only am I bullish, I think that we are on the cusp of a huge trend reversal for the yen and maybe at some point later next year for the US dollar overall. As always, timing is everything. That being said, I think one needs, and this is a really important part that I want to highlight, Patrick, one needs to be prepared for the move to start in earnest before the calendar year is out. The BOJ has been prone to do some funny stuff in December, and interestingly enough, the currency guru has echoed the same sentiments, though I am not sure what will be the catalyst. News follows price. Completely agree there. Then he says, for what it's worth, I think long rates in the U.S. are going higher. So, Patrick, he's instantly out of your books, good books, perhaps a lot higher. And I don't think that's going to be a hindrance to a higher yen at this juncture. Anyways, and then he just wishes me the best in the holiday season. So, Currency Whisperer, thank you very much for sharing your thoughts. Completely agree. Don't listen to me, listen to fellows that are a lot smarter like the Currency Whisperer.
So here's what I just flipped the chart because I know you hate when I do this, but this is the yen US dollar, right?
Okay.
But I just so that we can look at the yen bullishly, right? Like so we can actually look at it like a normal bullish chart, like as a turn, and observe at the same time. I put on a weekly so we can really kind of zoom out. And in fact, if I put it even on a monthly, you can see that the yen has been in a bear market for a decade.
Yeah,
more than a decade.
Terrible.
Right? And it more than halved. No, close to halved during that period. And so you could see why there could be a big macro argument made that the currency is getting cheap. But the interesting thing here is, will this start to be that bottoming accumulation cycle that technically happens at turning points? You usually see divergent momentum, which is the momentum stops accelerating to the downside, stops making lower lows, starts to create an extended basing formation. These are the types of things that you would start to see when the trend is shifting. And notice here that against that 50-week moving average, we've been basically below it pretty consistently throughout the bear market of the last 3 years. And there was an attempt to break out above it earlier, but this is a turn point, because if we have a sustained breakout back to above that 50-week moving average, this could start a new trend. And the whisper there and you might be very happy campers.
So, Patrick, this is some good shit that you're doing in terms of putting the picture, like zooming out and having a look at the big picture. And in fact, I was kind of surprised when you showed me that chart, because I felt like, the yen's gone up so much, you might have missed it. And in the grand scheme of things, you ain't missed anything. Like, you could argue, as you are currently doing, that the move hasn't even really started yet.
No, on a weekly chart, the move hasn't started. The move hasn't started. There, you've missed on a weekly chart. You've missed nothing.
Yep.
It has. It's like It's those that are grinding it out on daily and hourly charts for swing trades that are like saying, "Oh, I missed something," but like on a big position trade basis, there is nothing missed
All right.
on that front. Anyway, let's just touch on some of the currencies and then we'll commodities, and we'll go from there. Number one, I just want to touch on gold. And gold had earlier this week one nasty of a reversal. I think it was the de-escalation of the Middle East that I think spurred both oil and gold to have a reaction. Was there another reason that you heard out there? That was pretty much it.
Nope. It's Miss
And
Jackson, by the way.
sorry.
You said it's nasty. I said it's Miss Jackson. Miss Jackson,
Okay.
are you nasty?
Yeah.
Only
Anyway,
Gen Xers will get that.
fair enough. So the point being here that we have a scenario where gold is back up. Now, first of all, by the way, this was a contract roll on the continuous. Let me actually switch it to the Feb contract because that's more when you're rolling the continuous on the contango, it kind of messes up the chart. But we have a gold trying to bounce back above that 50-day moving average. But to me, this is actually a key moment. That reversal candle came right at the just above the 2700 level, which to me is like a key Fibonacci area for what could still be a two-wave correction. And if we see that the gold bulls can't make it and back up to the levels they were earlier this week, there is still the room for gold to take a trip below 2600 and maybe even a trip down towards 2500 in a correction with the way that this reversed. Now, that doesn't make me bearish. I wouldn't short gold on that. That would be just the levels where the buying opportunities will come. Because overall, the gold bull market is still very definitively in place. It's just we went so far so quickly that this consolidation is just what gold does. Like, look what it did in April through June. It spent 3 months just grinding it out and that was more of a sideways trade range, but inevitably it bullishly continued higher. And I think that we can have some further correction that could maybe even take the rest of the year. And that will inevitably resolve itself bullishly. But at this point, could be a trade range for the rest of December. The only thing that would make me immediately bullish is if this reversal candle, the one that started the sell cycle right here this week, is completely reversed. Because there's nothing more like from a price action perspective, when sellers come in and with a shock just hammer the market down, and the buyers say, "Oh no, I'll pick it all up right back up to where it was trading before," then that means that there was just a little bit of selling panic, but the buyers never really went away. And that would be the only thing that would make me more immediately bullish. Right now, it's right on the and it's an inflection point right here. You can almost literally use this 50-day moving average as an arbiter of the trend. Like if it stays below the 50-day, just wait for a buy on dip later in the month in December. And if it's staying on a day in, day out basis, closing above the 50, then maybe you can start dabbling that the gold bulls will run it again.
All right.
Nothing, eh?
Well, I do have something. I believe that you're playing poker against one player, which is the People's Bank of China.
I've heard everyone say that.
Well, and I think that if you think about their
I'm big picture
interest,
bullish. I'm just talking the technical.
No, I know you're, and the only thing about it is that the only thing that I worry about with that analysis is that the People's Bank of China. If I was sitting there and I was trying to accommodate, accumulate a large position, I would be using the technicals to my advantage, meaning getting people all bared up, getting people worried about.
But I wouldn't short it, and I don't think anyone should be shorting it.
No. But I'm just saying that at the very least, I would make sure that I don't create a situation where it starts to run. And so I would try to make it look as technically as bad. Like I would almost like purposely cause it for it to fail at key points. And
that would be the case there. But for me, I think that this is where the buying opportunities are, right? Like if for instance, if gold in some way broke that previous low down and broke, let's say, to 25.20, I think it'd be a screaming buying opportunity.
Okay, well then we're in
Right?
agreement
Like,
there. I think the
right?
worse
Like,
it looks technically, the more you should think about it, because I suspect that they are almost trying to make it look bad technically.
I don't know. Like, okay, I get it. PBOC is buying, and they're going to hold this thing up. But overall, I kind of step back and just try to look at it purely from a big picture of it's in a primary bull market, higher highs, higher lows. It was overbought and needed to take a break. It's taking a break. This looks like a very typical consolidation or correction in the market, and therefore there's no reason to be bearish. It and all dips should be bought. As
Okay. Yeah.
the way that it's got to be put in
Well,
simple
we're in
perspective.
agreement there, so we're probably wrong.
Crude oil. Will the infamous turtle head formation show up? This is the reason I say this is, okay, this has been a very distributed market, and lower highs, lower lows, a clear downtrend. And the only hope bulls have is that this trend line of all its previous lows holds. And, like, for me, whenever something so obvious is sitting there, you feel like the market's got to at least take one shot at it just to kind of to fuck with traders. Like this breaking to a low, like this temporarily breaking to a lower low to come back in is a price action that is not uncommon. And even though I think that this probably will be the fair value zone of oil, where the bottoms will ultimately come in, just a washout quickly for all those guys sitting with the stop losses below and those short sellers that will be eager to call this going to 50 or 40 on that break. Kind of just get them all, worked up into the trade, only to have it slingshot back the other way. I think that's highly vulnerable, but there's no reason to believe oil's starting to bull anytime soon. What is interesting, okay, I'll let you speak, though. These energy stocks don't seem to give a shit.
I think, yeah, like they're actually behaving well, you're saying?
Mm-hmm.
Yeah.
Well, not all energy, but the XLE particularly, it was right back to its previous highs. I mean, it had a little bit of selling this week, but that's just a typical kind of buy on dip. And so the question is how to read up on this divergence? Obviously, it's Trump, because obviously money flow into energy space is one of the theses of the Trump trade. And so that's getting some of the flows in the rotation. But you have to believe at some point, like for the vast majority of time, oil and energy stocks tend to correlate. They tend to generally have similar flows.
Yeah, but
And
oil stocks could go on a rally with oil going nowhere.
I agree, but it's not common. It couldn't totally happen, but it's more often than not. I'm for picking a number out of my head, I'd say 75% of the time you have to assume that oil and energy stocks will correlate. Now, there will be that 25% of the time where energy stocks can rip like this. But the question is that are energy stocks in some degree or another front running an oil move? Or is it just a temporary flows thing, and then they're going to kind of pause and wait for oil to supply demand shit to work its way through the system into the middle of next year before they start the next leg higher? It'll be something to watch.
And to that degree, Patrick, I also think that this is going to happen in the gold miners. I'm a big gold miner bull. I suspect that even the gold miners won't be able to spend money fast enough to lose the extra profit they're going to realize from the actual higher price of gold. And I think that it's obviously not a story for today or for this year, but I think that the gold miners,
they are very hated. Like I remember, you remember like 6 months ago when I'm going to pick on him just because it's the only name that popped up, but there was a shitload of people on the street. I know it was Hugh Hendry. It was one of them, but we're all saying, like the gold miners was the worst investment ever. Gold's been up and you can't touch this dog shit. And it's like, The moment everyone became consensus on that, the gold miners ripped.
Yeah.
It's just the way the market gods work, right? Like it's like you don't want to ever make a statement like that, which is the consensus view. It's
You don't actually have to say names out loud next time, Patrick. You can just call about the St. Bart's crowd. That's what
Okay.
you call it. The St. Bart's
Okay.
crowd was bearish gold.
gold miners.
Gold miners. They were bearish gold miners,
There you go.
and they were bullish
Okay.
TLT.
Oh, and we should talk about that. No, anyway, but listen.
No, let's talk about it. Go ahead. You love talking about
I do.
bonds.
But before we do, let's touch on uranium.
Yeah.
What's amazing is spot uranium has not joined the party. And I know that a couple of times this Sprott Physical has tried to pop higher, close the discount to almost nothing, and the spot prices just don't want to join the party. But yet, when you look at Cameco and URA, like these uranium stocks are running like the bull market is well underway, healthy and doing great. It's like, how long can this diverge? Is it going to be just like we're going to wake up one morning and spot uranium is just going to be ripping 10% a day and just like playing catch up on this? Or do you think these uranium stocks are just getting way ahead of themselves?
I'm not sure. Actually, I think that the uranium stocks it was the opposite. The U.UN rallied and nobody believed. None of the stocks believed. And now the stocks are finally getting a bit. And I think it has to do with the broadening of the uranium story. And if you go and you talk to a big Wall Street client, they're not going to buy U.UN. They can't. It's too small.
Yeah,
they're not allowed to probably buy that, but they can go buy Cameco.
And Cameco forward sold their entire uranium.
Yeah, but it doesn't matter. I know you hear all the doom, stuff, but I've always said that in a true bull, uranium market,
that shit don't matter.
That shit no matter. And the reality is, at first, Cameco will lead because that's where the money will go, like the big money will go, and then eventually we'll get to the point where the really crappy stuff goes, and that's when you start to get worried about things. But we're probably a long way from that. And if you go and you start, like we've been talking about uranium, because of Cuppy and all the other guests for a long time. But if you go on to Wall Street and you start talking about like big clients, they're just waking up to the uranium story now. It's not like this is, 2-3 years old for them. It is literally 3 months old for them. And it's just started. So be careful about that divergence between the stocks and the underlying. I think it could get a lot worse. And I think as long as the uranium story keeps going, it'll be led by the stocks, not by the U.UN.
Awesome. All right. Let's talk treasury bonds.
Okay.
And I have been very cautious to not try to come across as a treasury bond bull.
Sorry.
But
I was a combination of laughing and throwing up in my mouth, a little bit of both.
But over the kind of last month down over here, the consensus view of everyone that that bonds were the worst investment ever, and that they have only one place to go is lower, as long bond yields are going to go through the roof. When there was such clear consensus, it was so obvious in my mind that there was going to be a reaction. The question here, this reaction, is it the start of something more bullish, or is it just the typical, once the trade stops working, traders need to cover their shit and they start some reactionary buying that creates the retracement and the bounce the other way. At this point, I think TLT is going to hit 95, but is it going back to 100? That's the hard part. A bounce here of another dollar or two would be very typical, but I'm reluctant to get bullish bonds outright unless that recession word starts coming back.
Yeah, there's a lot going on here, Patrick, and I'm torn. My signal, and I share this with another fellow who's been on the show, and we kind of laugh about it, is that when people start asking about term premium, like or lecturing me about term premium. Like one of the big, like that was,
You're the one that needs to be lectured.
yeah, last September when I started getting lectured about term premium, like what am I like? I got to be one of the biggest bond bears out there for the longest time, and I'm getting lectured about term premium. I'm like, that was the only time that I actually have been long bonds, and I felt dirty about it, but I still did it. I had to buy it into that. Well, the worries about term premium are back, and they're very concerned about Trump and these policies. Having said that, I'm if we kind of talk about the squiggles versus the long term, I'm still bearish. And you won't ever find me not bearish on it unless something dramatically changes in terms of the way we go about balancing the books. Like if all of a sudden Trump said, I'm going to get the books balanced tomorrow, like I'm going to get the deficit to zero, and I'm going to raise taxes and cut spending till it gets to zero, then I would be in your camp and I'd be buying bonds, and over
the long term. You know what? I've never pushed back on your long term view, which is okay. Give me till the end of the decade. Over the next, let's say, remaining 5 years, bonds are going to be a shit asset to have in your portfolio, right?
Yeah.
So this I won't push back. But if now everyone backed off of a recession call, if for whatever reason the R word started becoming again, it wouldn't shock me if we had a TLT rip to 105 to 110 on the upside on a 6-month rip that basically just got it life of its own, squeezed out all bond bears out of their positions during that period, and then still your thesis would work out over a 5-year period. I think that there's going to be a tradable swing if the R word comes back.
Yeah, listen, I'm not going to push back against that, Patrick. I think there's better things to own than the TLT. I think that the Harley Bassman MTBA product is much better. I also think that even his TUA, which is his levered 2-year, the only trouble about the TUA now that I see is that will Powell play ball? Will he lower rates? Yeah. And so I know Trump's going to want him to lower rates, but what if we get a situation where part of the reason that we get this slowdown in the economy is because Trump's done tariffs? Will the Fed feel comfortable monetizing that inflation? And so it gets a little more complicated, and I am torn with it all. But I understand your
then just
argument.
Use Gamma to do it, and that way you don't feel dirty that you actually have bonds on your books.
But the trouble is that I think that in essence, the move is too expensive. Like in terms of the VIX of the bonds, I think the bonds volatility
what do you mean?
is too
Just do a lightener, open yourself up like a spread out of the money on longer term options that are farther out of the money. Make sure the capital outlay is a small amount, and you cash in if there's a big move, and if not, then it's a small enough thing that you just pretend you never had it on your books.
It's our little secret, Kev. If you want to do this, there's a way to
just
do
hide
it. Kev. You can be long. Just don't say anything.
Take your screen, and just put it all the way at the bottom, and just keep hitting insert.
Oh, that's what you do. That's
like
how
just hide it so that when you're looking at your positions, it never appears in there. You just you forget that it's there. All right. That's all I got, Kev.
Okay. Well, that's a great one, Patrick. Listen. Thanks for everyone for tuning in. Patrick, where can they find you?
You can find me at bigpicturetrading.com. You can follow me on YouTube at Patrick Ceresna and on X as well at Patrick Ceresna. Kev, where can they follow you, buddy?
They go to the Macro Tourist Substack. And listen, we can never have too many friends. We're just glad that you joined us on this ride. Now stick around for the after show.
All right. Well, my camera decided to act up like a bitch
spicy,
today.
A little spicy.
Like it's funny, like it's the right camera. Like I don't know why like my computer has just started doing weird shit, Danny. Like it's
I'm not going to say why. I'm not.
Yeah, exactly. We all know why it is.
Well, there's 2 reasons it could be,
Well, I don't know what the second is. I know the one though that everyone's thinking.
Yeah, don't look through your history.
Exactly.
guys are such wankers.
Oh,
Unbelievable.
I said farted. All right, Patrick, what beer are you drinking? You might as well tell us about it.
Oh no, just a super bock. It's,
it's like one of your standards.
It's the standard beer that Portuguese beer here. I'm not even gonna rate it.
I don't mind it. You know, it's the.
No. It's just standard. We've already had it on the show like 20 times. I'm not gonna keep scoring it.
I love it.
It's
I don't even know what you guys are talking about. I don't mind it. I think it's a great beer.
It's a light drinking, clean kind of beer that because it's a lot of warm season. So it's like when you go to like Barbados or Jamaica and you're drinking like Red Stripe or Banks beer or whatever. Like they always have these kind of light drinking island beers, and that's sort of what these things drink like, right?
I must say though, like in the UK, you can find Red Stripe. There's this whole craze for Red Stripe, and I must say that when you remove it from a very hot island and take it to a very cold island and drink it on that colder island, it tastes like ass. So if you put
like ass.
Yeah, if you put super.
I've never tasted ass, so I don't know what.
Oh god. Is it in a stubby as well?
Yeah.
Like, it is like when you get it like everywhere. Is it still in the stubby? And first of all, young people like Daniel don't know what a stubby is. Like, do you?
Of course.
Really?
Yeah, it's a smaller version. It's a half a bottle size.
No, it's not half bottle size.
No.
It's just fat.
Yeah.
But Patrick, was this maybe a Canadian thing only? Because for a while there was like it was all the world over. Like it was they standardized.
I don't know.
They standardized beer, bottles, and the reason was it was more efficient, and so you didn't have these weird shaped bottles, so you could just take it in. Everyone could recycle it. So I don't even know if it was just the beer companies agreeing to do this, or if it was actually legislated. But then what happened is some guys made like tall ones, and everyone started making different size bottles. But if you go look at like Bob and Doug McKenzie, terrific film, Strange Brew, for those who are interested, you'll see that they're drinking those little stubbies. And for the longest time, I feel like we just took them and sent them down to Jamaica or wherever they make Red Stripe, and they're using all of our bottles. Am I wrong?
You're not wrong.
I mean, the one that annoys me the most is the schooner, which is an Australian thing, and obviously the schooner is like shorter than a pint, and I find it irritating because it's the same price, but it's shorter than a pint.
Okay, so how do I spell this? I gotta look this up.
Schooner is SCOONER, schooner.
Schooner beer.
Yeah, and they tried to make this popular in the UK, still charging the full price for a schooner.
Yeah.
And it's just outrageous.
That's an inflation thing. They're just
exactly.
Yeah.
And it's
although
bastards.
What is the cider that's in Australia that they have the funniest commercials? Oh, Dixon cider. Have you ever seen this?
No.
Oh God. Okay, so after the show, go click Dixon cider and then click on funny commercials.
Brilliant.
Yeah. You can imagine it's pretty funny. I can't believe you guys out of all the people. If you're ever in Australia, you got to have a Dixon cider.
Okay.
There you go.
Okay.
Well,
all right. Do you have anything else you want to talk about?
No. Happy Thanksgiving weekend to our listeners. That's probably belated by the time they're listening to the show.
Yeah.
But, we're actually hosting. I'm hosting a big U.S. Thanksgiving party out here in Lisbon, Portugal. And there will only be, out of like 14 people there, only one American. It's gonna be we're a bunch of fakers. We're just gonna basically all pretend to have a great time because we're jealous of the Americans having a great party.
Are you gonna have turkey and are you gonna watch
absolutely
football?
doing a bit? No football.
No,
I mean we'll watch European football.
Really?
Not,
that doesn't
not
sound
American.
Right. That doesn't sound right.
Listen, we're doing it wrong completely. Other than the turkey.
I mean, Patrick has really gone to town on doing the turkey. Definitely stretched.
Why? What did you do?
I don't know, Pat. Do you want to tell them about your?
No. It's all good.
Did he spend an ungodly amount on his turkey?
Oh.
Did you ship it in? Did you fly it in from America?
Absolutely. From Minnesota, the capital of Turkeyville.
Oh, dear.
Okay, well, have a great Thanksgiving, belated Thanksgiving.
But listen, to all our American listeners, enjoy your great Thanksgiving weekend, and enjoy your Black Friday shopping. Are you doing any Black Friday shopping? I'm not.
I'm not. I have no idea.
I don't do this.
Yeah.
You know, I love those advertisements where they show like, the regular price is like $5.99, then they increase to $7.99, and then put like a 20% discount or whatever back to $5.99.
Yeah.
Stupid.
All right. Don't be insulting most of our listeners. We love it.
I'm not insulting the listeners, just the advertising of Black
That's
Friday.
right. Okay, fair enough. All right.
All right.
Happy Thanksgiving, everyone. Take care.
Cheers, everyone.